Market's been sideways now for 5 days, going into tomorrow's FOMC announcement. And I also think, let me just check, I think tomorrow's also, let me just check, there's also core inflation. So that's another big report. So tomorrow's going to be crazy. It increases the chances that today's going to be another sideways day. Here's the daily chart. You can see sideways for 5 days. The bears already have a wedge, 3 legs up, 1, 2, 3, but the shape is not good. The space between 1 and 2 is much greater than the space between 2 and 3. So we may have to get one more leg up, so maybe 1, 2, and then 3 before we pull back at least to this level, maybe down here. So I still think we're probably going to come down here at some point this year. My tennis buddies are always asking me, Al, is this the top? And I keep telling them, probably not, because in a bull trend, the market tends to continue to make new highs, and eventually at some point you get a reversal. But you keep getting a lot more new highs before you get the reversal. And usually you're not sure the reversal is underway until it's at least halfway done. So it's really hard to make money trying to pick a top selling. Yesterday, open of the week, a wedge rally. So we had a strong breakout and then a bull channel with 3 tops. Then we had a lower high right here, head and shoulders top. Yesterday on the open, we had a perfect double bottom with the day before, and not a very strong sell climax. Arguably a wedge, 1, 2, 3, or a failed breakout below a double bottom, or a spike pullback channel. And at some point in here, you have to decide that the market is going up. We broke to a new high here. That's why that bar is bigger. The bears tried to get a 2-bar reversal and a higher high double top, a test of yesterday's close, a test of the 60-minute and 20 and the 5-minute moving averages. And instead of reversing down, we drifted up. None of this is all that strong, so we could have gone sideways. Instead, we got a little breakout, and at some point you got to conclude it's a small pullback bull trend. And here we have consecutive closes above the moving average, but not near the highs of the bar. Here we have consecutive closes near the moving average, and both bars close near their highs. So even though it's not big, it's buy the close. So, if you didn't buy here or here, that would be a logical buy. That or buy above a bull bar, closing near its high, above that, above this, above that. And there's still plenty of opportunity to make profit. Now, is this going to be a sell the close bar? In general, if this bar was way up here, way above yesterday's high, and we had a big bear bar, let's say it closes near its low, I would sell below the first bar. But if we're near yesterday's low support, and especially at the bottom of a 5-day trading range support, I'm not going to sell below the first bar. If we get consecutive bear bars closing near the lows, then I would short, depending on how the bars look. But if I'm selling in the support zone, I want more than one bar. I want consecutive bars. But if I'm selling above resistance, I'm willing to sell below one bar. We're below the Globex low. 90% of days we go above the Globex high or below the Globex low. And for that matter, 90% of days you go above yesterday's high or below yesterday's low. So just like the Globex high and low are magnets, yesterday's high and low are magnets as well. Only 10% of days are inside days. Yesterday was an inside day. It's high at or below the high of the prior bar. It's low at or above the low of the prior bar. So yesterday's high and low are probably the single most important magnets on the chart, the most reliable. They get tested more than any other magnets, any other support or resistance. So you always pay attention to what the market does when it's around yesterday's low and around yesterday's high. And the same with the Globex, high or low. Bear bar, breaking below the 60-minute moving average, but this is the 5th sideways day. The bears want this to be a top, a head and shoulders top, left shoulder, head, right shoulder, a lower high major trend reversal. They want to break below the double bottom and a measurement down, and then they want it to continue a lot further down. They have a bull breakout, pull back, and channel. 1, 2, 3. So the bears are hoping we reverse down here. Well, I don't think that's 100 points from below, so we're not going to get there today. But depending on what happens tomorrow, we could get there on the FOMC report, especially since we have a potential wedge, 1, 2, 3, or 1, 2, and then maybe one more push, and that would be 3. I don't think we're going much higher over the next 4 or 5 months. I think we're going to put in a top and trade down into October, like we did last year and the year before. Weekly chart, really strong bull trend, very strong bull trend. So high 1 and a bear bar. So you got to bet there'll be a lot of sellers above that bar, and that we're not going to go up a lot further. We've got a pretty parallel bull channel, and there's room to it, so we can get up there before we pull back. But I don't think we're going up a lot higher. We have a bad buy signal bar late in the bull trend. Usually, you'll start to get a lot of sellers. I talked about how last year in October we rallied, and the year before October we rallied. Here, the top was July, and then we sold off into October. Here, the top was January, and we sold off into October. And I don't know if the top is going to be June, July, August, but I do think we're going to sell off into October. And then the market will decide, do we rally like we did last year and the year before, or do we continue to sell off? I talked about this measured move earlier, and the market is stalling right around that measured move. The bears wanted a double top here. We broke out, we pulled back, and we tested it. So the breakout and the pullback testing it tells us that this is a really important price, and the market likes to go for measured moves based upon really important prices. This is clearly an important price, and because of that test, we know the market is paying attention to that, and a measured move up there, and you can see there's some profit taking going on. So a lot of these bulls are wondering, is there much left to this rally? Should we take some profits? And that's why we're stalling here. I said that this is the weekly chart. That's a bad high 1 buy signal bar. Monthly chart, really strong rally. Okay, 5 bull bars, 4 of them very big. But then we had this. We had a bear bar in April. So a high 1, but a bear bar late in the bull trend here. A bear bar, high 1, late in the bull trend. Usually you're not going to go up much further. So we're probably not going up a lot higher. Here it went up for 3 more months and then sold off. I don't know if we go up 3 months, 2 months, 4 months, but probably not a lot more before we test down. And minimum test would be the bottom of the most recent bull flag, the most recent high or low. But I think we're going to dip below this breakout point. The market's been sideways for several years now. And when the market's sideways, and if it breaks above a key price, it usually will dip back below it. So I think we're probably going to go below the July high at some point this year. And the July high right now is about 4,800. Okay, this is the second bar of the day. And remember I said I would not sell below the first bar of the day, and you can see not many traders sold below it. Now we got 2 consecutive bear bars, but the body's shrinking. The close of 2 is above the low of 1, and we're far below the average price. So can you sell here? I personally would not. We're right at the bottom of a 5-day trading range. So I'd rather sell higher, or I'd rather sell after the market breaks below the neckline of the head and shoulders top. So left shoulder, head, the right shoulder, we have a perfect double bottom. The bulls are hoping that this is pullback from a rally from the double bottom. So the bulls want a double bottom rally, pull back to a higher low, and a resumption of the bull trend. And the bears want a lower high major trend reversal, head and shoulders top. Chances are we're not going to go far today because everybody wants to hear what the Fed will say tomorrow. And chances are the Fed is not going to say anything that is a surprise. They'll say everything is data driven and the economy is heading in the right direction. Unemployment is starting to tick up a little bit. And they'd like inflation to come down a little bit more. So probably no surprise with the FOMC. You could get a surprise with the CPI tomorrow. The surprisingly high number would be bad because it will mean the Fed will not cut interest rates. Can you short right here on the stop below 2? Well, 1 is the possible high of the day. So, if you're short, as I said, I'm not going to do it, but if you do short, you sell small, and then you can sell more lower. Like yesterday, if you bought above 5 or above 7 or 11, or any of these bars, buy small because it's not all that clear. And then once it becomes more clear, you buy more. Maybe you buy a little bit more here, and then the market is no longer in a strong bull trend, so you can exit up here. We had an extreme buy climax yesterday, basically a second leg trap. We had a very long first leg up, a pullback, and then a very brief second leg up, and bad follow through. So bears sold below bear bar closing below its midpoint. Probably more bears sold below 54 than below 53. And when you get these second leg traps, they most often happen in trading ranges. So when you get that and you get the reversal down, you're probably going to be in a trading range. So you take quick profits. Here, a test of the buy climax low. Okay, so this is a sell signal. Are a lot of traders going to sell when we get a big bear bar? Or is it going to be trading range behavior? You get a sell signal, and then there are more buyers than sellers. We're going to reverse up. Is this going to be a bear trap on the open and the low of the day? Yesterday, we had 3 out of 4 bear bars here, and instead of the market going down, we went up. It was a bear trap. If you look at the daily chart, 95% of days have at least a small tail on the top and a small tail on the bottom. It doesn't look like it here, but there is actually a small tail up there. Here, there's a small tail up there. And when you get the high of the day coming early, and there's a small tail, that small tail is usually due to a small rally on the open and a reversal down. And yesterday we have a small tail below, and it's usually due to an early sell-off, this, and then a reversal up. So you're always looking for reversals on the open. We're trying to get down to below that double bottom. 5-day trading range, 60-minute chart. We have a double bottom. And I suspect we're probably going to try to dip below it. We may just form a triangle going into tomorrow, but we may dip below it. I don't think we're going to break below it and fall for a measured move today. Just because I don't think it doesn't mean it won't happen. I have lots of opinions. I have a good sense of probabilities, what's likely to happen. And if what was unlikely happens, I don't fight it. I trade what the market is doing. So at some point, I have to sell. Well, we're so close to this, I'm probably going to wait to see if it breaks strongly below that, and then look to sell. Bears who are short right now stop above 1 or the size of a scalp above any bar. So the scalp is 5 points, so 5 points, 20 ticks, 22 ticks above the high of the prime bar. You always hear me say that by the close of bar 18, there's an 80% chance you've seen either the high or low of the day. Yesterday, close of bar 18, well, that was the low of the day. So by the close of bar 18, we did see the low of the day. About 1 day a week, you get a new high and a new low after bar 18. But 4 days a week, on average, 80% of the time, you have either the high or low of the day in the first 18 bars. So it's important to look for a swing trade during those 18 bars. And only 10% of days are relatively small trading range days. That means 90% of days have at least one swing up or down. So do the math, 90% chance you're going to get a good swing up or down, 40% of the day's range, 20 points or so. And it will begin with a good buy or sell signal bar. So we're collapsing through that double bottom. The open of the week, not many buyers. We're down at the next support level on here. 15-minute chart. Okay, so head and shoulders top, left shoulder, head, right shoulder. Lower high major trend reversal. The bears want the measure to move down. Looking good for the bears right now. Back to a 5-minute chart. The bar looks like this because traders are selling. And so it's okay to sell, but if you do trade small, March 21st high, that was an all-time high. So we're testing, you can see this is the daily chart. We're testing this high again. We've been oscillating around it for over a month. I want to go back to what I was saying. 90% of days have a swing trade. 80% of days have the high or low beginning in the high or low forming in the first 18 bars. So that means a swing begins in the first 18 bars. So it's really important to look at the first 18 bars because 80% of the time you get the high or low, and 90% of the time you're going to get a swing. So that's about 70% of the time you're going to get a swing that begins in the first 18 bars. If you're selling here, trade small. If you're selling here, trade small. And if it continues down all day, you can add. Sometimes on the open, you get a really strong breakout, and then a bounce, and then a channel down, so it becomes like a spike, pullback channel, a breakout, pullback channel. This is what the bears are worried about. Is it going to be a bear trap or a small sell climax and reversal up? This is what the bears are hoping happens, that you get a big breakout, the reversals up fail, and you get a channel down, so a breakout, pullback channel. Big breakout, the bulls tried hard to reverse, and then we got a resumption down. Can you buy at the market thinking that a lot of bears now only want to sell a rally? I wouldn't buy at the market. But if you get a bull bar closing near its high here, it's a buy. So if you're short, I'd buy back shorts. Remember I said that this might be just a test of the neckline of the double bottom. So it may be a failed breakout. So this current bar is really important. If it's a bull bar closing above its midpoint, I would get out of shorts above it. If it's a bull bar closing near its high, it's a possible low of the day, a sell climax and a reversal up. So it's a long, it's a reasonable buy above 5 if 5 closes maybe in the upper third or upper quarter of the bar. And where do you put your stop if you take the buy? You put your stop below the low. If this is a bear trap, usually if it's 1 or 2 bars, I call it a bear trap. It's a small sell climax. If it's 3 or 4 bars or more, I call it a sell climax, which is just a big bear trap. So if we reverse up here for the low of the day, I would call this a sell climax. I'm going to turn the screen off for a moment. I'll open up a PowerPoint. If it's just a bar or 2, I'd call it a bear trap. If it's 3 or 4 bars, I'd call it a sell climax. Sometimes you'll get like an II, micro double bottom, down, up, down, and then reversal up. Here, just a couple bars and a reversal up. I call it a bear trap. If it's more than that, I call it a sell climax. Bull bar closing near its high, possible low of the day, it's a buy. Possible low of the day, it's a buy. Big sell climax on the open, and the market trended up all day. Big sell climax on the open, it trended up, but it resumed down later in the day. 4 bear bars, 3 of them huge, testing yesterday's low, and then a small bull bar. You could wait for a bull bar closing in its high, maybe that bar. We got a higher low here. When you get a reversal up from a sell climax, and it becomes the low of the day, a lot of times the market just trends up for the entire remainder of the day. But it never looks all that strong yet. So a brief sell-off and then reversal that takes the rest of the day to undo the sell-off. So here we have the high and the low of the day in the first 5 bars. Just want a bull bar closing near its high. If the body is not big, they'll wait for a second bar. If there's a tail on top, they'll wait for a third bar. Sell climax, micro double bottom with a bad entry bar. And here it ended up forming a wedge bottom. Big sell off, reversal up, bull bar closing near its high. Big sell off. First reversal up didn't work. Second reversal up, we trended up for the rest of the day. Not a good buy signal bar. It's a bear doji, so most traders are not going to buy above 5. I would get out the size of a scalp above 5. Otherwise, your stop is up here above 1. And for the bulls, they need to get a bull bar closing near its high. What happens if we get a bull inside bar? 6. Well, then it's what I just said. Sometimes when you have a sell climax, you'll get consecutive inside bars. And that becomes your buy signal, even if it's a bear bar. Very good looking bull bar. It went down and up and down and then up there and then down a third time. So On a smaller time frame, this would be a wedge, and on this time frame, I'd call it a parabolic wedge. It's also a second reversal up on the day. We gapped down below yesterday's low, rallied, and this is a second reversal up. That increases the chances that will go higher. Bad buy signal bar, but eventually we got a decent bull bar. It went up a little bit, but it was basically a trading range day. Can you sell the market? Well, 5 is an inside bar in a bear trend, so it's a low one sell signal bar, but it's a doji bar, and you're selling at the bottom of the sell climax. So the market went up and it went down, so we had some buying during 5. That will reduce the number of bears selling below 5. The bulls are trying hard to get 2 things: consecutive inside bars, and then they want bar 7 to go above 6 to trigger the buy signal. And one of the annoying things is that there's often a report during bar 7. And so a lot of times the market will move very quickly at bar 7. I'm looking at the reports today. I do not see a report today at bar 7. A lot of times there'll be a news announcement. So a lot of times bar 6 becomes bigger in the final second. So it's hard to buy on the stop above 6 sometimes, because you think it's going to close at a certain price. In the final second, it jumps up and closes 6 ticks, 7 ticks higher. So what are the bears doing here? They're thinking, oh, we shouldn't be doing this. You know, micro double bottom and we're reversing up. Can you get out of shorts above 5? Yeah, I would, if you're going to get out of shorts, I would wait for the close of 6. And if 6 has a bull body, which it probably will, I would get out above 6. And for the bulls, they want to buy. They're hoping that this is just a failed breakout below the bottom of the 5-day trading range. Here's the daily chart. Today's the 5th day, sideways day. And you can see the tails, a lot of tails, big tail below here, tail above, tail below, fairly conspicuous tail there. Tails are reversals, and the bulls are hoping that we sell off and we reverse, and that will put a big tail on the bottom of today's bar on the daily chart. So far, today is a bear bar on the daily chart, but the day hasn't closed, and it may not be a bear bar when the day finally closes. Now, bears are selling the market. Why would the bears sell the market? Because they know if we go above the high of a bull bar closing near its high, a lot of bears are going to buy back shorts, and the bears don't want that to happen, so they're selling the market. Just like yesterday, bar 13, possible wedge, 1, 2, 3. The bulls bought. They did not want 14 to go below 13, because if it did, we could form a bear trend or a trading range. And if they could prevent it from going below 13 and triggering that sell, we could get a big bull trend. So a bear bar and the bulls prevented the sell signal from triggering. So 13 was a bear trap. Okay, so I would be out of shorts here and either long or flat. Possible low of the day. Micro double bottom. Doesn't look like it, but we were down on 4, and then on 5 we went up and down again. So I'll put up a 1-minute chart. Easier to see. Micro double bottom. I'm not looking at a 1-minute chart, but I can see what's going on. If I look at the 5-minute chart, I know there's a micro double bottom. I see we went down on 4, and then on 5 we went up and down, and then we went up on 6. So I know there's a micro double bottom. Now, for the bears, can they short below 7? After bar 6, I think most bears will not be eager to short. So probably buyers below 7. What happens if 7 is a bear bar closing near its low? Then you can short it. but I'd want it to have a decent sized bear body, not just a too thick bear body. But more likely, this is either going to be the low of the day and the start of a bull trend, or a trading range. So we may just start going sideways here. Big bull bar 6, but not sustained buying above 6. So that's bad for the bulls. But 5 and 6 are bad for the bears. We rallied twice. Up on 5, down on 5, up on 6. So if you're a bear, you don't want to see two pretty good sized rallies early in your bear trend. The bulls, the one thing the bulls do not want is 7 to have a big body and close near slow. They don't want a really bearish looking 7, because that would increase the chances that they have a breakout and then a pullback, and then we just channel down for the next 2 hours. Whenever you're waiting, the market is neutral. So we're waiting here. So that means the market is deciding on direction. And when you're waiting for more information. You're waiting for more bars. That means things are not clear. And when things are not clear, it increases the chances of a lot of trading range trading. If 7 closes near its low or on its low, it's a sell, but it's not a scalp, it's a swing sell. Down on 4, up on 5, down on 5, up on 6, down on 7. Reversals, trading range behavior. What happens if 7 has a small bear body? Probably more buyers than sellers below its low. The bears need 7 to have a good sized body and to close within a few ticks of its low. And without that, then probably buyers below. The bulls, at a minimum, want no bear body. Even a perfect doji is bullish. It's confirmation of the reversal of 6. Okay, so that confirms the reversal. It increases the chances that we're not going to go a lot lower. It increases the chances there'll be buyers below 7. It increases the chances there'll be buyers below 5. So you get more bulls buying. You can see that's happening on 8. Can you short below 7? I would not. Can you short below 5? Maybe you can short below 5, but if you do, I trade very small. Currently, the market is on the buy above 6, stop below 5. But we may be in a trading range. We're getting a lot of reversals. So if you are long, I would trade small. And if it continues to go up, you can add to your long as it goes up. Average bar lately, about 40 points, 50 points. So a swing trade is 40% of an average day. So 40% of 50 points is 20 points. If the day is a little bit smaller, sometimes the swings will be 15 points. So the bulls want the market to go at least 15 or 20 points above 5, which would be up here. Because of these reversals, up on 5, down on 5, up on 6, 7, down on 7, up on 8, a little bit down on 8, it increases the chances that we're going to get a pullback. The bulls want bars that look like that. There's a better chance the market will go higher faster. But if you get tails and bear bars, you tend to get more pullbacks. Here, not a good buy signal bar. Bull bar is not very big, So here, a weak rally, a small pullback bull trend, but a lot of bear bars, for about 10, 15 bars. Today is kind of looking like that. Reversal, and ended up as a trading range day. A lot of big bars increases the chances we'll go higher. We pulled back, higher low double bottom, higher low major trend reversal, and small pullback bull trend. What happens if 8 looks like 1? A big bear bar closing near its low. Bears will short, but this is a big enough rally so that we're probably not going to have a big bearish trend. So if we go down, it'll probably be more of a trading range. Never get upset by these big moves on the open that reverse. It's a test of the market is looking for direction early in the day. And sometimes it'll test support or resistance and reverse. And sometimes the test is pretty violent like that, and it still reverses. But, it's just the computer's testing a price and finding out that there are a lot of buyers there. Computer's testing a price and finding out that there are a lot of buyers there. Because yesterday was a perfect double bottom, it increased the chances that we would test below it. Waiting, right? Is 8 going to close on its high and above 7? If so, it could lead to a measured move up. If it does not, then we'll probably get a test down. Measured move above the high of the day. 8 did not close above 7. 7 closed above 6, so that's good for the bulls. So we're not going to measure move from the low to the 6 high, but that's not even the high of the day. So it's kind of like a spike and then a parabolic sell climax. So magnet somewhere where around here, where the parabolic sell-off began. Put up a 1-minute chart. I don't look at the 1-minute chart at all during the day, but we have a little bear breakout and then a parabolic sell climax. So basically a breakout in channel. There's a magnet at the start of the channel, which is a little bit above where we are. So somewhere up in here, there's a magnet. It's also a big round number, 5350, 5400, 5500, a big round numbers. But the 50s are also important. They're also magnets. Open of the week, a 50% retracement of the sell-off. 3 consecutive bull bars, right? Probably buyers below 8, buyers below 9. 5, a bad buy signal bar. So unless we start getting a lot of bull bars closing near the highs, we're probably going to test the 5 high, which is also yesterday's low and Friday's low. So we may come down and test this area. Can you sell and sell more higher? Betting we're going to come down here. I would not. It would either be long or flat. And if long, stop below 5. One of the most difficult things when traders start out is growing comfortable with these big moves on the open reversing. They look at it and say, how can that possibly be happening? It's simply the computer's testing support. And they discovered there were more buyers than sellers at support. Support yesterday's low. Remember I said 90% of days test yesterday's low or yesterday's high. And We're testing yesterday's low right now. I have one bull bar closing near its high so far, and that's a problem for the bulls. It increases the chances that we're going to have to test down and try to form some kind of a double bottom, a higher low, a lower low. The bulls need to get some more bull bars closing near their highs. Is today going to be an outside up day, below yesterday's low and above yesterday's high? These bars do not look like they're strong enough to support a trend all the way up here. Does not look like a good enough foundation. You know, maybe if we form a double bottom and start to get better bull bars, we can get up there. But right now, I would say 10% chance today will be an outside up day that will go from below yesterday's low to above yesterday's high. If we start to get more and more bear bars, instead of 10%, it becomes 30, 50, 60%. But right now, only 10% chance we're going up there. And what's the chance that this is a bear breakout, this is a pullback, and that we get a big channel down? Right now, probably 10%. So far, it's not looking all that strong. We have another gap. A gap is a space between two prices, and the two prices are the close of 9 and the high of 8. And so we do have a potential measured move up here from the low of 5 to the breakout point, which is the high of 8. And measured move gets us back to that old all-time high, May 23rd. There's a pullback in the bear trend, but too many bull bars, probably more buyers than sellers, 9 low and 5 points lower. Probably more buyers than sellers at the 5 high. What happened when we were at the 5 high here? There were more buyers than sellers. We went up. So the market may come down to test that 5 high again, yesterday's low area, to see if there are still more buyers than sellers, and there probably will be. By the close of bar 12, this is bar 10, but at the close of bar 12, 70% chance we've seen either the high or low of the day. Right now, by the close of bar 7, 50% chance we've seen either the high or low of the day. So right now, bar 10, probably 60% chance either this will remain the low of the day or this will remain the high of the day. And since we are rallying from support, at the moment it's more likely that we've seen the low of the day than it is that we've seen the high of the day. We broke strongly below the Globex low, and we're testing it. It's also a 50% retracement of this sell-off. If 10 closes on its low, can you short? I would not. This is a big enough reversal after a sell climax where traders should expect at least 2 legs up. So there probably are more buyers than sellers below 10, maybe a 50% retracement of this. Right, maybe around yesterday's low, maybe around the 5 high. So this is a buy zone in here. 50% retracement right now is here. If you're long, and let's say 10 is a bear bar to get out below 10, if it closes in its lower third, I'd get out below. You can always buy again above the bull bar or on a breakout above 10. So I would not short. What happens if we get 3 bear bars? It could come back. It could once again become seller close. But right now it's likely that we're going to test down to yesterday's low and to the 5 high and then the bulls will try to get a higher low somewhere down here. Ten minutes remaining in the hour. It looks like we're probably not going to close at the low of the hour. And I think we're probably not going to close at the high of the hour. And that makes the middle of the hour important. So bar 12 might close around the midpoint of the hour, that pink line. Fighting over the close of the bar. Their body, but probably more buyers than sellers, 10 low, 50% pullback, and 5 high. I'm sorry, that's the midpoint of the hour. 50% pullback of this rally is right around here. Better bar for the bulls. 5 minutes remaining in the hour. Remember, bars like to close near their high or low or middle. Bulls are hoping we can close at the high of the hour. It's unlikely we're going to close at the low of the hour. We still might close at the middle of the hour. And then up here, and we pull back on 7, and up again, pull back on 8, and then up on 11. So possibly a parabolic wedge. Then a couple small legs down somewhere to the middle. Bulls are hoping that this is going to be another gap, measuring gap. 7 closing above 6, 9 closing above 8, 11 closing above 10. The bulls are hoping that's a sign of strength, but there are 3 of them in a tight little channel. So this could be a parabolic wedge rally and the start of a pullback. Bulls, I'd get out below a bear bar. Now, normally I would say get out the size of a scalp below the prior bar. So do you get out 5 points below 11? Well, 5 points below 11 is down here, which is where I said I think there'll be buyers. So, I would not get out 5 points below 11, or I would either get out below 12 or below 6, because there probably will be buyers here if we come down here. By the close of bar 12, 80% chance we've seen either the low or high of the day. And right now, we've rallied for, 6 bars or so. It's more likely that we've seen the low of the day. Rallied for 6 bars and at the bottom of a 5-day trading range. 3 pushes up, 6, 9, and 11 in a tight bull channel. Smaller time frame, probably a parabolic wedge. Let's look at the 1-minute chart. Looks like a bull breakout in a channel. Many different highs. 1, 2, 3. I'm not paying attention to the 1-minute chart. Traders who are flat, they can buy at the market or they can buy a pullback. If you're buying at the market, I would trade small because you probably need to stop below 6. Because of this having 3 pushes up, we're probably going to get a couple legs down. It could start with bar 12. Maybe we'll go a little bit higher, but we're probably going to pull back. We closed the hour below the open of the hour. So a 60-minute chart, we reversed. We went down, we went up. But it's not a bull reversal bar. It's a reversal bar with a bear body. So it's a reversal bar, good for the bulls, but not as good as the bulls want. They always prefer reversal bars that have bull bodies. The bears are hoping it's a pullback from the breakout below the double bottom, but more likely we've seen the low of the day. Might test down a 50% retracement of this. Let me change this to here. So 50% is there. And magnet around yesterday's low, around the 5 high. So over the next 5 or 10 bars, we may drift lower. If we do, there probably will be buyers there. Kind of like this. Big sell climax, reversal up, and then a deeper pullback than traders wanted, but it's still a buy. Here we got one more leg up, and then a pullback. Can you buy the 12 low and put a stop below 5, low of the day? You can. Can you buy 5 points below 12? Some traders will buy the 12 low, buy more 5 points lower, and 10 points lower, stop below 5. If they're trading small enough, they can do that. Other traders will say, if I buy the 12 low, I don't want to risk down here. Maybe instead of buying the 12 low and buying more 5 points lower, I'll wait and I'll buy 5 points lower. The risk is you don't get filled if the market just keeps going up. There's nothing to short. Swing bulls want 20 points. So that's 80 ticks above 6. But for them to make 20 points, it has to go 82 ticks above, which is right there. So that's a target for the bulls. Unlikely we'll go straight there. So if we pull back, that would be a target. It's so close to yesterday's close that if we get there, we may go there. And it's possible it could be a 15-point swing day, which so would be here, but either there or here. Okay, so that's 15 points plus 2 ticks above 6, so that's a possible magnet, and that's 20 points. These are the 2 magnets. We'll probably get to this one. We may get to that one. But we may have to pull back first because this is looking a little bit like a parabolic wedge. Bulls trying to break above the high of the day. But it's not a good looking buy signal bar, 60-minute chart. It's a reversal bar. A failed breakout below trading range, but it has a bare body. So probably sellers not too far above the high of the first hour. Bulls are hoping 9 will be a measuring gap, which would get us above the high of the day in the 60-minute moving average. But we may have to pull back first. We're starting to get smaller bodies here. The high of the day, but a bad buy signal bar, 60-minute chart. So it's not a very good 60-minute buy. And a 5-minute chart, we have several possibilities for measured moves. We got this gap, and we have this gap. 11 closed above 10, and then 12 testing the breakout point. Back above that former all-time high, the May 23rd high. 60-minute moving average. We're at a 15-point target. I think we're going to get to the 20-point target for the bulls who bought about 6. Yeah, we may pull back at any time, but this is becoming increasingly bullish since bar 4, every low at or above the low of the prior bar. So a 12-bar bull microchannel. Unsustainable. You know, can you get 20, 30, 40 bars without a pullback? I've never seen 40. I have seen 20 or 25, but it's rare. When I talk about the microchannel, well, it's a term I coined. And what it is, a bull microchannel. Here, this low was below that low. But for all of these bars, every low is at or above the low of the prior bar. So if all the lows are at or above the low of the prior bar, it's a microchannel. This is a sign of very relentless, sustained buying, but it's unsustainable. This is 25 bars. This is the most I've seen that I can remember on the 5-minute chart. 23 bars without a pullback. 21 bars that are bear bars, but no pullbacks. Some 15-point bulls taking profits here. A bigger bar. It's possible that it's a measuring gap and we go outside up. It's also possible that a lot of bulls will say, wow, that's a big bar. What a great opportunity to take some profits. We'll probably pull back soon, so maybe I'll take some profits here. So a big bar late in a bull trend often attracts some profit taking. So this is bar 16. 75% chance we've seen either the high or low of the day. And right now it's much more likely that we've seen the low of the day. So today will probably not be a bear trend day. If we sell off, it'll probably be a bear leg in what will become a trading range. So right now, the day will either be a trading range day, legs up and down, or a bull trend day. When you get these really big bars late in the bull trend, 60% of the time, you're going to get at least one more leg up. But 60% of the time, either it's going to be the end of the trend, at least temporarily, or that one more leg up will be the end of the trend. We got the 20-point target here, yesterday's close target here, yesterday's high target there. When it was down here, I said 10% chance today would be an outside up day. Reverse up from below yesterday's low to above yesterday's high. And what's the chance now that today will go above yesterday's high? Right now, I would say 40%, so it's still unlikely. But the more bars we get, the higher the probability that today will become an outside up day. Do not want a bear bar closing near its low, because if it goes below the bar, you'll probably start to get profit takers. So they prefer not to have any bear bar, but if it's a small bear body, they'll be happy because it'll reduce the chances of much profit taking. So the fight now is over the size of the bear body, 16. The closer it closes to its low, the more likely we'll get some profit taking. If it closes in the middle, we'll probably go up a little bit more before we get profit taking. What about selling and selling more higher, betting that you can make a profit and buy more lower? When a trend looks like that, it's usually better not to sell. A high one, but a bear bar. So probably not much more up. Also, 15, a big bull bar late in a bull trend. It's usually exhaustive. So 60% chance you get another leg up or 2 or 3 bars, but then get the pullback. So 60% chance either the pullback starts here or we go up and on for another few bars and then get the pullback. High one, but a bear bar and a small black climax 15. So it's a risky buy above 16. Better not to buy above 16, better to wait for a pullback. Stop order bull scalpers, 16, needed to go up 22 ticks above 16, 5 points. So probably sellers, probably the bull scalpers will take profits, and that's right around here, which is 20 points above 6. 20 points is 80 ticks, and this line is almost exactly 82 ticks. That's where the bulls need the market to go for them to exit with 20 points. Right now, They can exit with 15 points, which is this red line. I'll get rid of that. Go for them to exit with 20 points. Right now, they can exit with 15 points, which is this red line. I'll get rid of that. The next measured move target is here, very close to yesterday's close. If we get there, we'll probably continue up to yesterday's close. Can we get a second leg down after this? Can this be a pullback and a second leg down? Right now, I think probably 90% chance we've seen the low of the day. Obviously, if we get a series of bear bars, instead of 90%, it becomes 80, 70, 60%. But right now, 90% chance we've seen the low of the day. And that means traders will be eager to buy pullbacks if they get an opportunity. Probably profit taking around here or yesterday's close. So somewhere in the next 5 points, we'll probably get a pullback. Here are those sell climax opens that I showed earlier. A lot of times the market rallies for the remainder of the day. It's unusual for it to rally this much. Today's kind of like this. Here, a second leg up and then a pullback. So we might do that. Today's more like this. Just sustained buying above the earlier high and then a pullback. Chances are, after the pullback, we're going to get at least one more rally. Big bull bar, another leg up a little bit higher, and then more of a pullback. So I suspect we're going to do something like that. Not much higher, and then a pullback. Big rally, second, third leg up, and then a pullback. If 18 is a bear bar, can you short below it? I don't think there's a lot of profit to be on the short side. I would get out of longs below 18 if it's a bear bar, especially a bear bar closing near its low. But it's probably better if you get out instead of shorting, looking to buy a pullback. Maybe down to the 15 low. Can 15 be a measuring gap? It's possible, but I think it's more likely the beginning of exhaustion, so 15 and then 17. I don't think we're going to go up much more before we pull back. And when we pull back, as I said, I think it'll be very difficult for the bears to make money. This is a very strong bull trend. So better to look to buy the pullback, wait for 2 or 3 legs down, and then a bull bar closing near its high, and then buy again. Bulls trying to get to their target. And this is strong enough so that we're probably going to get there. No selling, all right? You might get some bulls selling at that red line. 82 ticks above 6, the buy signal bar. But bears are not going to be eager to sell this. If it goes sideways for 5 or 10 bars, and you get a double top, or if you get a low one, a reversal and then a second reversal, you'll get some bear scalpers. Any selling that we get over the next few bars is going to be mostly bulls taking some profits. So probably not going to lead to much of a pullback. Can we get that? Today's rally is so strong, I don't think we'll get a big pullback like that. I think it'll be more like this, mostly sideways. Can we get that? It's possible we can get a surprise plunge, but bulls will buy it. Micro channel, how much of a pullback did we get? Not much. Micro channel, how much of a pullback? Relentless buying for a long, long time. Bulls very eager to buy at or above the low of the prior bar. If it finally goes below the low of the prior bar, bulls will buy, and it usually prevents much of a pullback. Here, 19 bar bull microchannel, little pullback. Here, 18 bar bull microchannel, little pullback. That's a bear microchannel. That's in the wrong section. I'm going to move it. 17 bar bull microchannel, 2 or 3 little legs down, but then higher. 14 bar bull microchannel, surprisingly big reversal down, and the end of the bull trend. If you got a deep sell-off, you're probably in a trading range. 13 bar bull microchannel. Over 2 days, a 17 bar bull microchannel and a big reversal. But on today, started here, just 3 bars. A lot of bull bars, 17 bars without a pullback. Today it began at bar 4, and this is bar 19. So that is 16 bars beginning with bar 4, with every low at or above the low of the prior bar. Maybe it will come down to the high of the last hour, and bar 1 high, but probably not much lower. Remember, on the 60-minute chart, it was a reversal bar, but had a bear body, so it's not a very good buy signal bar. So we'll probably come down and test that, but there probably will be buyers there. Just shy of what the bulls need. Okay, it went up exactly 80 ticks above 6. It needed to go up 82 ticks, finally, a pullback. Are there more buyers or sellers below 18? Probably more buyers. Maybe we'll come down here, but we're probably not going to go down very far. So should you buy or sell below 18? If you're long, you could take profits or partial profits. If you're flat, you could buy 18 and buy more 5 points lower, 10 points lower, and use a stop way down here. If we get consecutive big bear bars, get out below consecutive big bear bars. Best choice is wait for a bull bar closing near its high, maybe bar 20, 22, 25. So somewhere in here, wait for a bull bar closing near its high, possibly bar 20, right? It's possible. 19 is just a bear trap, and that we continue up. Bull's trying to create a gap, 20 low, 1 high. But that's a lot of bear bars, so that's enough selling to make it likely we're going to dip below that red line. Not necessarily here, but at some point today. Bull's trying to get a good high one buy signal bar 20. They want to get a bull bar. They'd like a bull bar closing near its high. They'd like a bull bar closing near its high with a fairly good sized bull body. But it's a buy climax and a good reversal down 19. We're probably going to get a couple legs sideways to down. So anybody buying above 20, they probably need a wider stop, somewhere down here. What happens if we get consecutive bear bars, like 1, 2? Well, then it'll increase the chances that we'll go lower, but it's unlikely that we're going to get a bear trend. So any sell-off will either be a bull flag and we'll go higher, maybe a wedge, 1, 2, 3, or it'll be the start of a trading range. Bull microchannel. You have a lot of bars without a pullback, and you get a reversal. It's probably not going to go very far. Lots of examples. Right? 17 bar bull microchannel. We sold off for 10 bars, but we still ultimately went higher. So lots of examples. Look at all these charts that I'm showing of microchannels, and how many of them where you have microchannels of 10, 15, 20 bars, how many of them lead to big bear trends? Here's one, 12-bar bull microchannel. But what about today? If you get 15, 16-bar bull microchannel, like this, 17. Well, that's over 2 days. I'll leave that down. But, okay, so here's 14. You got a deep pullback. But most of the bull microchannels that last a lot of bars, the reversals do not fall very far. You just look at them, very small reversals. The 60-minute reversal bar had a bear body, so you'd expect there to be sellers at or above its high, and there are. Now, it's reasonable to buy the 18 low and to buy 5 points lower, 10 points lower. So we're probably not going to go very far down here. The bears are hoping to duplicate this, hoping to get a series of bear bars, but unlikely. For the bulls, it's a high one, a pullback and a bull trend. But it's consecutive bear bars, probably sellers above, and it's also a buy climax. So when you get a reversal from a buy climax, you're probably going to get a couple legs down. So probably sellers above 20. Can you short the 20 high and use a wide stop? You probably need a really wide stop. So if you sell the 20 high, you probably have to sell more 5 and 10 points higher. So you probably need like a 15-point stop if you sell the 20 high. What do the limit order bulls 18 do? The bulls above the 18 low. It hasn't gone down low enough for them to add on. So I think a lot of them will get off break even. If it goes down 5 points below 18, they'll buy more. If it goes down 10 points below 18, they'll buy more. And then if it gets back to the 18 low, they can get off break even on their first buy and with a profit on their lower buys. And for the bears, they got to wait for, I think, some kind of a double top or a wedge. Or, it's possible you can get a series of, you can do this again, but very unlikely. 10% chance we're just going to reverse all the way down. So this is more likely a pullback and a bull trend than it is a start of a bear trend reversal. See, they bought the one high. We dipped below it and we bounced. So more buyers than sellers at the one high. But consecutive, decent sized bear bodies closing near their lows, probably more sellers than buyers above 20, looking for at least a couple legs sideways to down. The bears tried to get a top here. So this area is a magnet. So it might come down here, 5 or 10 points below 18. Good looking bull bar, double bottom 16. But I still think we're going to get more sideways to down. So if you buy, I think you still need a wide stop. Bulls bought 5 points below 18, and they got filled, and they're trying to exit. You see the high of 22 is exactly at the 18 low. And why are we stalling there? Because you got a bunch of bulls who bought 5 points below 18, and they needed to get one tick above that 18 low to exit with 5 points. It was reasonable to buy the 18 low because we knew the first reversal down would be minor. And therefore, some bulls bought the 18 low, 5 points lower. Other bulls bought 5 points lower. And they needed to get back to that one tick above the 18 low so they can get out, break even on their first buy and with 5 points on their lower buy. Now, for the bears, it's a lower high double top, but I think traders will not sell below 23. We should get above that 18 low, so we should go at least a tick higher. There are a lot of bulls with limit orders to sell right there. And the bears are not stupid. They know the bulls need it to go one tick above 18 low. So you get a bunch of bears selling at and just below that 18 low, trying to force these bulls into selling. You know, the bulls are going to sell. They need it to go above the 18 low, but the bears are trying to stop them from getting what they want and forcing them to sell lower. But a really strong bull trend, so we should get above the 18 low, which we just did. Can we keep going up? I think it's more likely that 19 and 20 are strong enough so that we'll get a second leg down, especially after a big buy climax. Remember, at the close of 15, I said 60% chance we would get one more leg up for a few bars, and 60% chance either 15 would be the end of the bull trend, or that one more leg up would be the end of the bull trend. Now, the end of a bull trend does not mean the start of a bear trend. It could simply mean a couple legs sideways to down. It's possible that it means just that and the bull trend resumes. I think it's more likely we're going to get a couple legs sideways to down. It's possible we could get 3 legs down, 1 pull back 2, pull back 3, and form a wedge bull flag. But I think chances are we're going to get more down. So can you short below 24, a lower high? Yeah, I still think it's better to be looking for buys than sells. If it goes sideways more, then I think bears might be more willing to sell. But at this point, I think it's better to be simply looking for buys. So wait for a double bottom 22. So maybe a few bars down, double bottom, maybe a lower low double bottom from 4 to 19. That's your micro channel. So that's 16 bars. And in those examples, okay, here's 19 bars. Okay, 13 bars. Okay, so it's more like this: 17, 18, 19 bar bull microchannel. The point I'm making is when you get these bull microchannels that last a lot of bars, 15, 16, 17 bars, 20 bars, this is the kind of reversal you get. You don't get a bear trend, all right? So the chance of this being a bear trend, probably 10% chance of a new low of the day. So 90% chance either this becomes a bull flag and we get another leg up, or we just start to enter a trading range here. If we do get the other leg up, it's a possible wedge. Remember, we still have not gone 82 ticks above 6, and this is a very strong bull trend. So we should hit this red line. But there probably will be profit takers there, and then the bears will think we have a wedge, 1 sell-off, 2 sell-offs, and maybe a 3rd sell-off. And even if we get it, it probably will only lead to a trading range. Okay, I'm going to step aside. It looks like 16 is probably the start of the trading range. The top of the trading range is probably somewhere up here. And the bottom of the range might be here, might be a little bit lower. Okay, Brad is going to take over. Hope you have a good day.
Hey everybody, give me just a couple of minutes here and I'll have my screen up and loaded. You can see we're rallying up to the high close, bar 18. Strong enough reversal up, we're probably going to get a second leg. So even though we might pull back at the test of the 18 close, I'm not willing to sell in this kind of environment. We're always in long. Therefore, the only thing I want to be doing is looking to buy and scale in lower, or simply buy lower. Give me just a few minutes. That is a trade I'll regularly take. I bought as 19 went down and scaled in lower, and just took profits at a test of the high of the day. I'll have the screen turned on here in just a moment. What do you do if you're long and you bought around 21, 22? It's okay to be long. And I think it's reasonable to at least consider taking partial profits. New high of the day, probably going to pull back soon. But just look at a 15-minute chart. The rally is so strong. Odds are we're going to go at least a little bit higher. Pretty regularly, I'll fade the test of 18. But in a situation like this is really much stronger than I really want it to be if I'm going to be selling. Therefore, the only thing I'm looking to do is be long or buy pullbacks. Something's acting up with my microphone. Give me just a minute and I'll fix it. Strong breakout bar, but probably a trading range. Therefore, bulls buying below. So I think the downside is limited. Give me just a moment. Okay, so what about now? Can people hear me, or, I mean, obviously if you can't, you're not going to know, but let me check Discord and see if there's any comments. The sound should be better now. Okay, great. Yeah, there was a setting toggled off on the microphone. So what I was saying is, strong enough rally, there's buyers anywhere. Buyers below here, buyers below here. Even 27, as big and scary of a bar as that is, look at a 15-minute chart. Do you really want to be selling here? Absolutely not. And I'm one of those bulls. I don't want to sell out of my long here. I want to buy more. So when I look at something like this, even though this went further down than what I expected, the way I look at it is it's a trading range. It went further down than what I wanted, but the reality is we're probably going to go sideways. 2 legs down. There's buyers in this general area, and we're probably going to remain in a trading range. 27 is disappointing for the bulls, though, and that may entice some bulls who bought below 25, bought below 26, and more lower to exit on a bounce. But overall, I think we're going to be sideways here. So I really do not want to be selling. Bears, they want to get follow through with 28. But I have to say, the Bears would need to do a lot more than 27 to convince me to sell down here. You can see Al mentioned bad 60-minute buy a few hours, the first hour. We broke above it, now we're pulling back. Strong enough rally, we're probably going to get a second leg. But no surprise. Open of the day right here, and look where we are. We're right around the open of the day. So again, what you have to remember, bull trend, micro channel lasting a lot of bars, trends evolve into trading ranges. Lots of selling pressure here. The odds are we're not going to have a relentless, strong bull trend for the rest of the day. But here, we're probably in a trading range. Strong enough breakout 27, we'll probably get a small second leg down. But I suspect there's buyers not far below 27. So I'm really, until we see more selling pressure, I'm not all that eager to be selling here. Probably buyers after a couple of legs sideways to down. Bears, you had some bears selling on the way down, and they're deciding what to do. Somebody sold the low tick of 27, scaled in higher, and they're deciding, are they going to exit at the low of 27, break even on their first, profit on their second, or are they going to sell more lower, causing us to get a deeper pullback? At the moment, I suspect there's probably buyers below the prior bar. And below 27. So I'm really not all that thrilled to be selling here. And if I do anything, I suspect I'd be buying using a wide stop scaling in lower. That's not that, that's fairly tricky as well. Easier thing, wait for the market to go sideways and wait for a second entry buy. That's the easier trade. Some bulls, they would exit below 26, or when the market went a couple of points, maybe 3, 4, 5 points below 26, they would exit, and then they'd look to buy again above a bull bar. We've probably seen the low of the day, and therefore, because of this rally, the downside is likely to be limited. 50% pullback of the rally 5 low to the 18 high or the 25 high is around 48 even down here. You can see, what did the bears do below 28? Well, a lot of those bears scalped out. They sold, taking a chance we'd brace to the bottom, and then when we started to stall below 26, they immediately started buying back their shorts. And the bulls know that. So what do the bulls do? Some bulls just buy the low one below 28 and use a wide stop scale in. Other bulls, they wait for the sell-off to eventually start to turn up. They wait for the sell-off or the entry bar, current bar, start to stall and reverse up, and then they immediately start buying. This is the problem. The biggest problem for the bears right here is risk. When you're selling low in a trading range, you have really bad risk reward. And if this is the bottom of a trading range, the top of the range is somewhere up here. Now, the other problem for the bears is this might be a two-legged pullback in a bull trend. So we might get a rally, complex pullback, go sideways, and get a second leg up. So if you're a bear selling here, we could easily go above the high of the day. This is enough selling pressure that I think the upside is limited, at least for a little bit. But I do believe bulls who bought anywhere in here and more lower, I think the reality is they're probably going to be allowed to get out of the trade, which means we're probably going back here. That's why you hear Al say break-even stops are really not ideal, even though traders use them all the time. Mathematically, they don't make sense. The reason break-even stops are not ideal is two reasons. One is there's no such thing as open profit. Your profit, your risk is the market price to your stop. So if you sold the high of this move, if you sold right here where my pointer is, the high of bar 25, and now the market's all the way down here, this is risk. If you're short, it doesn't matter if you sold below the prior bar or you sold the high tick of this move, you have this much risk if your stop's up here. And therefore, a lot of traders aren't willing to risk that much because they know the odds are we're going to pull back. Trading ranges, if you think about a trading range and a trend, I think of everything from the perspective of trapped traders. I'm always thinking about the traders that are trapped. They're selling down here. They get trapped into a losing position. They're forced to buy back their shorts. And when that happens, it creates a strong rally. Most of the time, trapped traders can avoid a loss. If they buy the 25 low, they scale in lower, or they look to buy after 2 or 3 legs down, the market will typically retest the high. If you buy up here and buy more lower, it'll typically retest it. In a trading range, even if you sold here, bar 50, and you just sold more after 2 or 3 bear bars or waited for a trading range to resume up here and sold when the selling pressure increased, look what happened. The market came all the way down here. If you bought here and then the market rallied up to here, look what happened. Price retested your entry. So when the market's in a trading range, I expect gaps to close. And because of that, I expect limit order traders to make money. Do you really want to buy, think about 31 or 29. Do you really want to sell down here? Not really. You look at 25 and you look at 27, you think to yourself, 27 is a good bar. It's a good bar for the bears. But there's a tail below 27 and the context is really, really bad. I often say I want the market to break below the moving average and get follow through, and then I conclude the market's always in short. And that's a generality statement. You still have to apply context to the chart. Here, I need to see more than this right here or this right here. Yes, higher high major trend reversal. So we have a possible break below the neckline and a measured move down. But at the moment, I think we're going to be more in a trading range. Tight bull channel, we had 3, 4 bars down, 3, 4 bars up. That's probably a minor reversal. This is enough to be a major reversal, 2 legs down. But now we probably need a couple of legs up. So if we get 2 legs down, and then maybe we rally and form a wedge with decent bear bars closing below their midpoints or on their lows, then we'd have a better shot at getting a reversal. Here, I'm I have a hard time believing that this could lead to a strong sell-off. I think it's probably going to be a leg in a trading range. So if traders buy and scale in lower, they're probably going to make money. I'm going to turn the screen off for a moment. But again, just to be very clear, I am not willing to sell this low in a trading range. And by sell, I mean go short. And really selling out of longs down here is not ideal either. You can see bears 28, low 1, who sold the low 1, disappointed by their entry bar 29. Some of those bears bought back their shorts. Market's still deciding, are we going to get a second leg down from 27, or is 29 the second leg and we're going to reverse? Another bear bar, but still disappointing for the bears. Good bar for the bears, but context is not ideal. Bears trying to become always in short, but if we sell off below 29, it's basically 3 legs down. Bulls, they really need a reversal bar. It'd be better if this bar is a bull bar closing on its high. That would be 3 pushes down, and that would probably convince bears to exit shorts. For me, if I was a bear and I was short and 31 closed on its high or near its high, I'd probably get out above or a couple of points above the bar. The odds are we're in a trading range and we're probably going to pull back here and test somewhere in the middle. We may not have seen the high of the day yet. We could easily rally all the way back up here. So always in bears, they probably exit above 31. Bears trying to get the downside breakout, but look where we are. You're right around the midpoint of the rally. So really not an ideal area for the bears to be selling. The reality is there's buyers below 31. There's the low of the move. Here's the high of the move. And you can see 48.50 is the midpoint of the rally. So I suspect the downside's probably limited. Obviously disappointing though for the bulls. Probably in a trading range here. So I suspect we'll probably rally back into this area over the next several bars. Why did some traders exit after 34? We had bull bar 31, but it was a small body, and then bad entry bar on 32. And then you can see we had a bull bar 33. So it's basically a variation of 2 legs up. But the reality is probably a trading range, more likely than the start of a strong sell-off. I think a lot of always in bulls exited. I think a lot of always in bears get out above 31. And then what do the bulls do? Did they buy above 31? Some would, and some would get stopped out below 31 and look to buy again above 36. Other bulls, they probably use a wide stop, maybe a measure move down in the signal bar, and look to buy more at the low of 31, taking a chance that it'll be a failed breakout and lead to more sideways trading. Just look at the 15-minute chart over here. Do you really want to be selling after this many bars up with a big bear bar and a bull bar, 2 big bear bars, bull bar? Not really. To me, it looks like we're going to test all the way back up here. And I wouldn't be surprised one bit if we did that. We had a high 1 buy, and the entry price is 59.75. And if the bulls who buy here and more lower, I think the reality is those bulls are going to make money. So I think the target, I think we're going back to the 59 and 60 area. Turn the question box on, and I'll take a look at the question box or the questions here in just a little bit. Again, I would not be short here. This is a trading range. Odds are we're going to rally. It's easy to get upset by this price action. And one of the most important things is when you're confused, just step aside. The more you understand about price action, the more the confusion goes away. But overall, trading range, we're getting a lot of bars below the moving average, and that's good for the bears. But context is not ideal. So look at just again, 15-minute chart. This is a pretty strong rally, and it's probably the first of what will become a second. It's a leg one. This is probably not the second leg up. It's very common for the market to get a strong rally and get a second leg that's minor, and then get a deeper pullback followed by a larger leg up. So at the moment, I think the odds are we're probably going to go higher. Again, another bull bar. I think it's getting more and more dangerous for the bears to continue to hold short. So I think there's buyers in this overall area. For the bulls, higher probability if they wait for 2 or 3 bull bars and to close above the moving average. You can call it a wedge, 27 and 29, 31, and then a failed breakout below the wedge, 35. Or you can call it just a larger wedge. You can call it a final flag. So we had a sell-off to 27, pause, second leg down, 35. But overall, odds are we're probably going to rally. Again, I would not be short here. Too much risk that we're going to go higher and at least test into the middle of this overall range here. Bulls trying to get the reversal, trying to get a close above the moving average. Odds are we're going to rally and get all the way back to the 24 low, 25 low, and we could easily test all the way up to the 25 high. Here's the euro dollar, and really interesting. We've had, zoom out a little bit. You can see lots of trading range price action. We made a relatively big bear breakout and pretty much an endless pullback test of the highs. And we had a breakout here. So in other words, we've been in a trading range. We had a bear flag. We broke above the bear flag over here back in May, middle of May, around May 15th. Two-legged pullback and then a rally testing the highs. And then we got this really big bar. This is a strong enough bar. It was a surprise. Surprises get second legs. Bears, they're trying to get follow through selling. I think the odds are we're going to test back into this area over here. But the more selling pressure we get, the greater the probability that we get a second leg down. I don't know if we're going down here. I think we'll probably pull back, but this is damaging for the bulls. You see what's happening? Bulls are buying. The reason they're buying is because they understand it's a trading range. Remember what I said about the high one up here? The entry price, $59.75. That's basically right here, the high of this bar. So this here is the high of the high one over here on the 15-minute chart. I know it's upsetting. It's so easy to buy and get stopped out down here, or to buy here, get stopped out on 35, only to watch the market go your way. And you have to learn. The market most of the time is in a trading range. And what you have to learn to identify is leg count. You have to learn to count legs. You have to learn to identify moves that are strong enough to get second legs. This is a lot of buying pressure. And even though this is a disappointing sell-off, the odds are we're at least going to go sideways. So the bulls buying anywhere in here, if they put a stop all the way down here and scaling lower, they're going to make money. Now they're not actually putting a stop all the way down here at this magenta line. the stop's not going all the way down here. Because think about it, your risk reward would be terrible. So what are the bulls doing? Bulls are buying and putting a stop somewhere down here, and they're exiting when their premise is no longer valid. That's one of the hardest parts about using wide stops, is you really have to understand your premise. And whenever you have a risk reward of 1, you're betting on high probability. If the probability is not high, you cannot have a bad risk reward. A bad risk reward is anything where your risk is equal or less than your reward. Therefore, if you're risking $100 to make $100, you have to have probability favor that trade. And what traders have trouble with is similar down here. They sell here and put a stop all the way up here. And they are just unable to exit the trade. They're unable to recognize when the probability is shifting. And because of that, what ends up happening is they sell here, they get stopped out all the way up here, and they take this really, really big loss. When the odds were the trader's selling here, they're selling, but they're going to be quick to get out. They sold here, some sold more, got out break even. Someone asked in the question, why did this reverse? Why didn't we get a second leg down? Al said we're probably going to get a second leg up from the rally at 18. Why didn't he say we get a second leg down with bar 4? Because 4 is a very climactic bar. And this blue line is yesterday's low. So here's the low of yesterday, here. And you can see we broke below it on bar 4 and reversed up on 6, 7, and 8. This is a sell vacuum test of the prior day's low. And look at the sell-off. This is not good selling pressure. It's selling pressure. It's not ideal. Big bear bar, smaller bar, and then a really, really big bar. That's not what you want to see when you're getting a breakout. What you want to see is this, bull bars. This is overlap and extreme, but it's a micro channel. It's not too climactic. It is climactic in the sense that it's a micro channel. However, it's not one really big bar. So what's happening here? You have traders selling. Traders are selling because we had a bear breakout 27, pull back to the high of 28. That's the top of the channel. Sold off for a couple of legs, and we're rallying back to the channel, the start of the channel, the 28 high. But we're overall in a trading range environment, and therefore I think there's buyers below scaling and lower, and we'll probably end up going at least a little bit higher. I think less likely this is going to be a double top and we race quickly to the downside. It's possible, but at the moment I think it's unlikely. 39 is a buy climax. Big bull bar closing on its high with a lot of overlap after 38. And buy climaxes often get a pullback, so it's possible 40 is just a sell vacuum test of the 39 low, the bottom of the buy climax. With a 5-bar bull micro channel and 5 consecutive bull bars, I think there's probably buyers below 40. Disappointment bar 40 for the bulls, but the bears, they need a decent follow-through bar. Bears need more selling pressure if this is going to be a double top that breaks below the neckline 35. Otherwise, probably buyers below scaling in lower. You can see, look at the 15-minute chart. You're in the bottom third of an overall trading range. And that's really not a good area to be selling. So, confusing picture. And whenever you look at the market and it's confusing, you look at the moving average and it's relatively flat. Whenever you have the moving average relatively flat and the 60-minute moving average relatively flat, you know the market's fairly neutral. 41, we have a bull bar. And 40, let me back up. So 40, you had a bear bar closing on its low. But look what happened if you sold it. It's basically selling the bottom of the tight trading range. The odds are bulls who bought the close at 39 and more lower are going to make money. Now you have a lot of bulls who look at 39 as a bad risk reward trade. You're buying in the bottom, you're buying high in what is a trading range. Like I said, 30, this right here could be the top of this trading range. Let me go to a 1 minute chart. I can show you. I still think we're going higher. So basically right here, way to sell off, look at a 2 minute chart. The reason I'm showing 2 minute charts, it's really important to understand markets are fractal, and therefore all the patterns you see, you can see them on other patterns. You can see them on other time frames. Way to sell off, deep pullback. That is the start of a channel. And you can see right here, if I can fix this trend line, there, spike, pullback, channel. So 3 or 4 legs down, depending on how you count it. Here's the top of the channel. Here's the bottom of the channel. Channels convert into trading ranges. We've converted into a trading range. And you see the channel up here. We have several pushes up. And the rally, you can call it a wedge on this time frame. Doesn't really matter. The point is, this is buying high in this trading range. So a lot of traders, they look for a pullback. Should you be trading a 1 minute chart? If you are not consistently trading a 5 minute chart very, very well for a very long time, you should not. I look at 1 minute charts, look at 2 minute charts, look at 4 minute charts. I do that to practice understanding that all charts, all price action works on all time frames, and better at understanding patterns. But my focus is one chart, one time frame. That's the only thing I want to focus on. That doesn't mean I won't trade other time frames. But overall, my focus is the 5 minute chart of the E-mini. I still think we're going at least a little bit higher. Bear bar 30, 40, so we may get a small second leg down, but we may have already had the second leg. It may have been implied on a smaller time frame. Look right here. Sometimes it's easier to just look at a higher time frame. Do you really want to sell this? I mean, think about it. If you're a bull, and let's say you bought the close, say you bought the close of this bar, are you really going to panic? If you bought here and put a stop all the way down here, are you really going to panic when you see this? No, of course not. You're going to buy here, you're going to buy more lower, buy more lower. Odds are really high that the market's going to retest and go all the way up here. Now, a lot of bulls, they saw this bear bar here, and they bought, they scaled in lower, they got out on the retest, understanding that the odds were to go sideways, and they bought more, they bought again down here. But the reality is, even if we go sideways for several bars, we're probably going back up here at some point fairly soon. Bears getting a second leg down after 40. But again, middle of a tight trading range. Until the bears get a strong downside breakout, odds are we're going to be within this overall range. I have this line here because it corresponds to the exact high of the 15-minute bar right here. High of this bar, 39.75. High of this bar, 39.75. It's a high one on the 15-minute chart. High ones often have sellers above, and they typically lead to pullbacks and get trend resumption. Sellers above the high one, pullback, odds favor resumption and a test of the high one. Bar 42, bull bar, probably going to go higher. You can see on the 15-minute chart, do you really want to sell below the prior bar? Yeah, probably not. And you can see in the final 30 seconds of this bar, on the 5-minute chart of 42, it rallied and closed as a bull bar. And that created a tail on the 15-minute chart. Bears, they got a second leg down with 40. But look what happened. Traders bought it. Why did they buy it? Because we're stabilizing. Very strong rally. Strong report bar. Let me just take a look here. I'm showing no reports right now. that bar, obviously, we had a surge up pretty quick. That makes me think we're probably going to go at least a little bit higher. I still think we're going higher just for the simple fact that of what I mentioned on the 15-minute chart. So this is looking good for the bulls. Obviously, we're at the high one here. The red line, that's the high one. I think we're going to go to the high of 25, and we'll probably get to yesterday's close. Would I be selling here? Absolutely not. We're at the high one. I'm going to get rid of this line. I'm actually just going to move it up here. That's the high of the range. This is what I was talking about. All the bulls who bought 24, close at 25, below 25, below 26, steering 27, they're all making money if they were just patient. Can you buy this? In general, my rule of thumb, I think most traders should wait for the bar to close. But the reality is, it's an outside bar. It's a surprise, and surprises typically get second legs. That makes me think we're going to go higher. I'd rather wait for the bar to close. Some traders, they'll flip to a 1-minute chart. And let's say they trade 1 E-mini. What they'll often do is, by the way, if I had to pick between trading 1 E-mini and 10 micros, I would pay the commission and trade 10 micros and just live with it until I could trade a couple E-minis. But one thing that I'll typically do is I will trade a 20% position size. So if I can't decide, if I know I want to be long, but I can't decide how to get long, I'll just buy at the market and use a wide stop and look to scale in lower. That way I can at least participate and be in the trade. Top of a trading range. So not a terrible idea to consider taking part off. When you look at this bar, we're not racing quickly to the upside. And there's a reason for that. Traders are disappointed. You have some traders that exiting here disappointed of the pullback. That's a big enough bar that I suspect we're going to go at least a little bit higher. So we're always in long, big bar, big risk. You can buy above it or buy the close if you can be quick to manage the trade. So if you buy the close of 43 and you put a stop below 43, what do you do if 44 is a big bear bar closing on its low, maybe closing around 57? Well, worst case, if you're long, you just get out below the bar. That's why I think always in is such a great way to learn how to trade. It can help teach you to understand where traders exit. 15-minute chart. I think we're going to get some kind of second leg. Let me just draw it on the 5-minute. You have disappointed traders up here, and the market is still deciding what kind of follow-through we're going to get. Relatively big bar. It's possible that we get a bad follow-through bar. Bulls, they want this. I don't think they're going to get this, but they might get half of it. So maybe if that's 100%, here's 50 and 75. That would be 50%. That'd be 75%. Do you sell below 44? I would need 44 to be a relatively strong bar in order to convince me to sell below it. It's a disappointment bar for the bulls, though. If I'm a bull buying 43, it's disappointing that 44 is not racing to the upside. And because of that, that is a warning that we're still within the overall structure of the trading range. Someone said it was the 10-year note auction. That makes sense. Whenever I see a big bar, the worst thing you can do is panic. If you feel any emotions, step aside and just wait. Bears, You'll see this is 3 pushes up, 1, 2, 3. So again, big bar, forcing traders to buy relatively high. Midpoint of the prior bar is 55.25. It's actually 56.75. So the midpoint 56.75, and the market is tested down to 57.75. Some traders don't want to buy the close of 43 because they expect a pullback. What would I need to short? I would need 44 to be a relatively strong bear bar closing on its low in order for me to consider selling below it. Even then, I'd be hesitant. 43 is a strong enough surprise. I expect we'll probably get at least a small second leg up. But this is disappointing. The bulls are they're not eager to buy the close. A lot of traders, what I'll sometimes do if I'm long, let's say I'm long, and in this case, I've been long. I've been long for about 8 or 9 bars. Then somewhere back in here, taking a chance we would test back up to this range, and I just used a wide stop. But typically, when this started racing up, I dragged my target, one of my targets, I dragged it higher. Now I moved it to the close of 43. Why did I move it to the close of 43? Because you have some bulls who bought the close of 43 and they're disappointed. Some of those bulls scaled in lower and they're deciding what they're going to do. The odds are we'll at least go 1 tick above the close of 43. I still think we'll go a little bit higher, but whenever I'm in a trading range and I'm high in the range, I want to start selling out of my position. I don't want to have a full-size position at the top of what could be a trading range day. It's possible second leg trap, rally, pullback, second leg. Tail below 44, probably buyers below, but certainly a disappointment bar for the bulls. Disappointment bar for the bulls. I dragged my target 1 tick below the close of 43. I'd rather wait at this point for the market to clearly break out of the range than to hold this trade. Okay, I just got filled. So now I'm back to flat. I still think we'll get a second leg up after 43, but this is a trading range. And because it's a trading range, I'd rather wait and see a more clear breakout. I'm going to get rid of these extra lines here. By the way, thanks everybody for that went to Orlando. That was a lot of fun getting to speak to everybody. Just hearing everybody's backgrounds. It's always fascinating to me when you have all sorts of people from different countries, cultures, backgrounds, and they all get together in one room. It's really, really fascinating. But it was really enjoyable getting to hear everyone's stories and viewpoints with trading. For those of you that went, I am going to record the presentation I gave. I'm also adding more slides. As most of you know, those of you that are there, I talked about always in and major and minor reversals and the importance of understanding them. And so I'm adding a few slides. I'm not changing the presentation, but I'm adding more pieces to the presentation, and I will record it all. So just a little bit of patience on that, and you should have it fairly soon, but it just might take a little bit to get it all recorded. You can see we're above the 44 high and starting to go sideways. I still think we're going to get another leg up with 43, but whenever I have bars like 43, they're climactic bars. I call them emotional bars because they're big and they convince traders to buy high in a trading range. I think this context is a little bit different. You know, the reason I have this leg one, leg two, rally, pullback, second leg, it's possible the leg one is here. Rally, complex, pullback, second leg it's very common most of the time when you get a strong rally. The second leg is not this. Usually it goes higher. So I do think we're going to go at least a little bit higher, you know, maybe somewhere up here, 66 in that area. But whenever you get a big bar, it's climactic and it causes traders to want to take profits. So for me, I'm on the sidelines. Here, when I was long, my plan at a target, I was basically going to take half off somewhere in this area and swing the balance. My hope on the trade was 36 would be a bull bar, 37 would be a bull bar, 38 would be another big bull bar. Let me just turn the screen off. I'll show an example. I still think we're going to go at least a little bit higher, but I'd rather buy once this moves stronger. You know, something like this, trading range, a bottom, and a bull bar. Let's just assume the prior day was a big rally. Bull bar, another bar, another bar, another bar, and then we broke to the upside. Different example, rally, deep pullback, bear breakout. So this is kind of like bar 27 right here, bear breakout, couple of legs sideways to down, big bull bar follow through, more follow through. Here, if we would have gotten something like this, I'd have been much more willing to buy closes and hold the trade. So really not what you want to see if you're a bull. We have good bull bar on the 15-minute chart. We still will probably get a deep pullback. Do you sell? Can you sell at the market? And I'm hesitant to sell here. And if anything, I'd probably be interested in buying, taking a chance that we rally. We have a breakout point, the 39 high, so that might get tested. Chance that we rally. We have a breakout point, the 39 high, so that might get tested. But overall, you know, fairly disappointing for the bulls. Some bears sold to close at 44, sold more higher above 44. They're deciding what to do here. I do want to say one thing about Orlando. Those of you that went, you know, a lot of people said they had a lot of fun and it was really enjoyable. And, you know, it's really easy to be excited whenever you go to one of those events. You know, you hear from people, you get all, you know, excited, hyped up to trade and study. But, you know, at some point, a week after the event, 2 weeks after the event, you get back to the emotions of the event fade away and you kind of get back to reality. And what I'm saying is just because you went to the event does not mean you're automatically going to be a better trader. You've been given a lot of resources from the event. You got to watch Alan Daly trade. You got to see their emotions. You had, you know, 140, 150 page workbook from Ali. You have presentations from all sorts of presenters, and you heard, you know, everyone got to ask questions to everybody. You know, Tim Fairweather answered a lot of questions. Tim Stout did. Obviously, Al and Ali answered a lot of questions. What you have to do is take that information and actually apply it and study it. You know, it's kind of like just because you bought Al's video course does not mean you're going to be a better trader. What you have to do is actually take the information and apply it. You can sit in this trading room, and if you watch every day live, you will become a better trader. But the reality is if you don't apply the information that you're learning, you're not going to be that much better. So what I'm saying is you have to remind yourself, it's been about a week. The emotions are probably fading for most people. They're getting back to reality. Take the information and apply it. Go through Reality's workbook. Really think through all the examples. Think through the presentations. They're all going to be recorded. But the point is, you still have to apply the information that you're learning. One thing that I highly recommend is I like TradeZilla for it. I'm not trying to, there's plenty of other, I'm sure, software companies that do that. I don't really know of them other than TradeZilla. You can use an Excel spreadsheet, but I'm a big fan of going through and cataloging your trades. You can use a spreadsheet, but it's a lot easier if you use one of those softwares that you can plug in to your broker. It's just faster. And so let's go back to the chart. 46, bear bar closing on its low, second entry. And it's a little bit challenging. If you get out, I think the bulls, I think it's okay to get out below 46 and then buy again if it's a bull bar or wait for a breakout. Bottom of its tight trading range, bottom of a 3-bar trading range, so not an ideal sell. But this could be a second leg trap. Just look at this. Price went, it looks like one tick above 25 and pulled back. Does that look like the bulls are just desperate to buy? No. So for me, if I was still long, which I'm not, I would get out below 46 and look for another trade. We still have this gap right here. So here's the gap. Bulls want to close it. Okay, so back to why I brought up the TradeZilla. And again, I'm sure there's 50 other softwares you could use. So the point is, it's really the application of it more than anything. So it doesn't matter what you use. Use an Excel spreadsheet. Every day, go through your trades and mark the trades. Why did you take the setup? And it's better if you can categorize them in a searchable way. So if you're using Excel, filter them in a way that you can tally. Like if you're making mistakes, are they late? Is it a mistake late in the day? Is it a mistake entering too early, not waiting for 6 to 12 bars? So based on the various trades that I take, I filter. Was it a breakout trade? What leg was it? And then I can look through, I can look through a month, a week, 30 days, whatever. I can look through and, see how everything is. Are there trades I'm being impulsive? Is there trades that are not really what I'm trying to do? And, how effective are they? The point is, measure your results. I like to think of trading as you're working for a hedge fund or a prop firm. And you're working for a prop firm that if you don't follow the rules, they're going to fire you. There's an Ask Al video on that. About he likes to think that he's working for Goldman Sachs, and if he doesn't do what he's supposed to do, Goldman Sachs will fire him. One of the problems with trading, and again, some bears will sell, taking a chance we test down to the 41 low, which we might. Bulls, I'd get out below the prior bar. One of the problems with trading is flexibility. Trading requires discipline, doing the right thing. One of the ways I've found that to be helpful, think about percentages. Don't think about risk. Don't think about profit. If you're looking at TradeStation and you can see your profit or account balance down here, just turn it off. Turn it off. Don't think about it. Because that's how real traders think. So good bar for the bears. Closing the gap makes me think we're going to go at least a little bit lower. Test down to the 41 low, excuse me. Do you have to sell right here? No. If this is going to be, let's just assume hypothetically, let's discuss the chances of getting down to the low close bar 4. Do we have to sell right now in order to catch the swing down to the low close? No. If we get a big bear bar here, another big bear bar, we're probably going to the low close. So there's time to wait. This is a big enough bar. It does make me think we're going to go lower, so that's good. Strong enough breakout, second leg down, likely. Probably going at least a little bit lower. Always in short? It might be. One of the issues with trading ranges is by the time it's clearly always in short, you're at the bottom of the range. I think this is strong enough for a second leg, and that's why I'm saying it's always in short. But, if I'm a bear selling the close of 47, I really want to see a strong follow-through bar 48. And if I don't see it, I'm disappointed, and I would consider exiting. So you have some bears selling, look happy to scale in higher, but they really want to see strong follow-through. Otherwise, they may exit. Bulls who did not buy, who did not sell out of longs below 46, they're trapped, and they may use any bounce on 48 to exit. A minute into the bar, and we haven't triggered the sell below 47, so that's disappointing for the bulls. Probably going at least a little bit lower. But where is the follow-through? That's the one problem for the bears. You buy above 48 if it closes like it is right now? I would not. Probably sellers above the bar, and will at least go one tick below 47. Not what you want to see if you're a bear. So some of the bears who are short and scaling in, guess what they're going to do? They may look to exit around the low close of this bar or be quick to get out on a retest. But again, I still think we're going to test back down to the 47 close and at least get a small second leg down. Some bulls bought the 44 low, scaling in lower, deciding what to do here. This is a good example, though, of what I was talking about earlier. You don't have to sell here. The more you wait for a bear breakout, wait for a strong follow-through bar, the greater the probability. Disappointment bar for the bears. Bulls, breakout, pullback, buy. Bull breakout, 43. Pullback, 47. And a buy setup, 48. So let's see what we get here. I still think we may have to test down to the 47 close. So the bulls, probably better to wait to see what the follow-through looks like on 49. It's possible 49 is a retest of the 44 low, where bulls got trapped. It's possible 49 is a retest of the 44 low, where bulls got trapped. But bears are disappointed, and they'll probably use whatever reversal down we get to buy back shorts. We still may get a second leg up from the rally here. Rally, pullback, second leg. Not what you want to see if you're a bull, hoping that 48 is going to lead to a strong rally. Bears, they're deciding what to do. Bears that sold the close of 47, scaling in, what are they going to do? Are they going to exit, break even on the entire trade? Or are they going to take a chance that we're going to get down to the 47 close? 49, low 1. Probably buyers below. But I am a little bit concerned that we may get a small second leg down with 47. Low 1, 49. Probably buyers below. So disappointing for the bears. But 47, decent bear bar. That makes me think we may have to go sideways before we break out above 45. I thought we would get a small second leg down, but traders instead are buying. We still may try and get a second leg up here. So the bulls have a chance. Let's see what they can get. Probably going to go higher. Bears, they want a reversal down after 50. But strong enough reversal of 47. Probably buyers below and a second leg up. Yesterday's close is a magnet, and we probably will get to it. Bulls trying hard to get the upside breakout. We have an inside bar, but let's see what we get here. Top of a trading range. We'll probably, I think we're going to try and break out. Decent rally, trading range. We're probably going to get some kind of second leg. But the bears, they're doing a good job preventing the bulls from getting the breakout. So let's see what we get. The bears, they want a wedge. 1, 2, 3, but bad symmetry. Bulls trying to get the breakout, but so far they don't have it yet. I still think the odds slightly favor the bulls. But the bulls, they need to get something here. Otherwise, we may have to pull back. 51 low, 48 high. Any of those are possibilities. Part of the reason why I think we're going to get a second leg is this initial rally here. Usually this and usually 25 and bars like 43 are not the second leg. Usually the second leg is something that looks more clearly like a second leg. It doesn't have to go all the way up here. It might. I think it'll probably go, maybe somewhere up here. Yesterday's close, 53.70 area. I thought we would get a second leg down after 47, and instead the bulls got trapped. The bears got trapped. So right now we have the breakout, but let's see what kind of follow through we get. More traders giving up. So far, good looking bar. Probably going to go at least a little bit higher. Better for the bar, better if 53 closes on its high. What I pay attention to intra-bar is how the bar is forming. So here's an example. I want to see the market form consecutive bars. I don't want the rally, this is a 1 minute chart. I don't want the rally to consist of just one bar. I want to see a series of bars. And you can see that if you're just paying attention to the bars it's forming. Is it going up and pulling back halfway? Is it steadily going up? We have a tail on 53, a little bit disappointing, but probably going to go at least a little bit higher. So good for the bulls. Enough of a breakout of the trading range. We'll probably get at least a small second leg up. The more we go sideways, every minute that we go sideways, you'll have more bulls exiting. So we have a minute, and we're a minute into bar 54. Traders really want to see immediate follow through. That would increase the probability that we're going to go higher. Similar over here. Good breakout bar. Are we going to close? Are we going to get a strong follow through bar? Or is this going to be something disappointing? That's what traders want to see. Traders want to see. So traders are paying attention to see what the follow through is going to look like. Follow through bar, 54, good for the bulls. Probably going at least a little bit higher, but a small follow through bar. You can see on the 15-minute chart. Trading range, bull breakout bar, closing near its high. Because 54 is an inside bar, it's basically a high one, but it's a high one after a breakout of a trading range. Therefore, I suspect we'll get at least a small second leg up. Bears, they want a parabolic wedge. Rally 49, pullback, rally 50 or 51, pullback. rally 53, it is a parabolic wedge, but it's also a breakout of the trading range, and that increases the chances that we go higher. So too early to be selling here. Getting follow through. Good for the bulls. Every time we get a bull bar, we get a small follow through bar though, which is a little bit disappointing. But 15-minute chart, you can see. Now, what are the chances that we get a measured move here? I think we probably will. I don't know if we're going to do it today. I mean, it's possible, but that's still, it's only 10 points away. Measured move in this trading range here or here. May do that. I'm going to remove this for now. There's the measured move target. Probably will go at least a little bit higher. Strong enough rally, first reversal down, probably going to fail. So always in long. What do you do if we get a bear bar closing on its low? You'll have some bulls exit, or they might exit 3 or 4 points below the bar and look to buy again lower. We may try and go outside up on the outside up. There's the high of yesterday, right here. High of yesterday, 75.75. We're close enough to it that we may try and get there. You can see pulling back. Probably buyers below though. Bulls giving up, but it may just be a test of the trading range high, bar 45. 56, a little bit of a surprise, so may get a second leg down, but traders want to see how this bar closes. 56, a little bit of a surprise, so may get a second leg down, but traders want to see how this bar closes. Bears, 15-minute chart. They want a strong reversal bar. Bears, 15-minute chart. They want a strong reversal bar. What about selling below 56? I think it's probably better to wait and see what the follow through looks like. This is not enough to undo this. It's enough to at least halt the buying and maybe get a second leg down, but I'd like to see more from the bears. 15-minute chart closes in about 3 minutes. Bulls, they're trying to create as big of a tail as possible on the 15-minute chart. That would lower the probability of traders selling below the 15-minute bar. Bears, they obviously want this 15-minute bar to close on its low. You can see it. This pullback may just be a retest of the breakout point. And you have bulls buying, trying to defend the breakout point. Breakout point right here, 45 high, is 62.75. Low of this bar, 63.75. And you can see bulls who bought the close, scaling in lower, looks like they're going to be forgiven. So that's the danger of selling here. It's easy to sell to go short and then fail to realize that you just sold the bottom of a trading range. Trading ranges are pullbacks. And every pullback is a trading range. Most trading ranges get trend resumption. We have a rally, 1 bar trading range. It's probably going to try and get trend resumption. I think we may try and go outside up on the day. We're so close to it and it would be pretty much a leg 1, leg 2, rally, pullback, leg 2. That makes me think that we're going to get up there. And we still have time left in the day. It's only bar 57. The 15-minute chart's a great example of why you should wait for bars to close. If you look back, I mean, really a few minutes ago, this current bar on the 15-minute chart was mostly closing on its low or near its low. And then in the final 5 minutes, really the final 3 minutes of the bar, we rallied and it looks like we're going to close the bar near its high. So the appearance of a bar can drastically change in the final couple of minutes of the bar. You know, I equate that really to percentages because it's the same on a daily chart, 60-minute chart. The appearance of a bar can change by just because a bar looks one way in the first 10, 20% of the bar, it can look totally different in the final 10 or 20% of the bar. 57, strong enough reversal. I think we're probably going to get a second leg up. Therefore, probably buyers below 58 and another leg. Again, we're so close to yesterday's high, this blue line. I think we're going to get up there. Follow through bar 58. Good for the bulls. Probably going higher. I do think, I think we'll probably get up here, 53.80. I just don't know if we have enough time to get there before the end of the day. So yesterday's high is reasonable. And yesterday's high is 75.25. I am long. I've been long for a little bit. I took a chance over here that we were going to break above, that we're going to break out of the range and get a second leg. I thought 56, although disappointing, I thought the bears needed one more bar. And I thought at least 50-50 chance. 56 was just a retest of the breakout point. Sell the bears, they sell 50.45. Hearing 53, they get trapped 53, 54, 55. They use the pullback to buy back their shorts. I've targeted 74 even. I think it's going to go higher, but I like to exit before it reaches resistance. Okay, I just got filled. Why did I exit there instead of the high? Well, this was overall disappointing. I thought we would make an attempt to yesterday's high, and it was good enough risk reward that I'm happy to just get out and wait. We're so close to it, and you know it's common. This is enough momentum that I think we'll get above yesterday's high. But it's also common for the market to come within a few ticks of yesterday's high, pull back for a couple of points, and then retest it. Would I be selling here? No way. Too much buying pressure. So looks like we're going to break above it. But I wouldn't be surprised. 5.75 is the high. We've come within 3 ticks, and we're starting to pull back. We may pull back, maybe test the 55 high before we get up there. Measured move. Target of the trading range, 35 low, 45 high, is 57.5, and we came within 2 ticks of that measured move. Always in long, probably going to go higher. I'm flat, and I'll look to enter on a pullback at this point. Bears, they're hopeful. This is leg 3. 45, 55, and then a third leg here. But strong enough second leg, probably leg 1, pullback leg 2, and then leg 3. Plus, we're so close to yesterday's high, I'd be hesitant to sell. This is too strong for me to sell. That even if we got a bear bar closing on its low here, I'd be a little bit hesitant to sell it because my expectation is we're going to at least go 1 tick above yesterday's high. We went this distance below yesterday's low, 41 to around 34. So that is the distance. That is the distance of how far we went from yesterday's low to the low of the day. We may go that same distance above. So it's possible we have to get up to near 53.82 and make the day symmetrical. Now, I mentioned 80.25 was a symmetrical leg. Let me see if there's time to talk about this. I mentioned that we may have to go up to 82, which adds symmetry. We went this far below yesterday's low, the blue line to the low down here. We may do the same to the upside. That would actually increase. That would get us to a measured move target of this right here. $81.25 is the open of this bar to the close of this bar. Say that, let me double check. Yeah, 80.75 is the measured move target. So we may actually get there. Climactic bar on the 15-minute, so we may pull back for a couple of legs. A little bit of a parabolic wedge. Rally, pull back, rally, pull back. If we rally here and pull back, it's a small wedge on a smaller time frame. But the channel up it's a breakout. It'd be a small pullback rally on the whatever clearly had the wedge. Look at a 1-minute chart, we'll see a wedge, but that's a breakout on this time frame. I think we're going at least a little bit higher, closer to the 80.75 area. That would create symmetry on the day. Bulls on the daily chart. Talk about the daily chart for a minute. The bulls, they're trying to get a second leg from this rally. Rally, pull back. They want a second leg up in a test of 5,400. We came within about 15 points of 5,400. I suspect we're probably going to get closer to it. So we'll probably reach 5,400. I do think we're going to get a small second leg up after the June 5th breakout bar last Wednesday. So maybe breakout, pullback, second leg. I did buy a small pullback of 60. I bought a 60, went a couple of points below 59, and I scalped out. I thought about buying a close of 60, but I decided against it. I think it's okay to be long, just far from the moving average, and I tend to scalp out more. So at the moment, I am trapped out and waiting. Tail above the bar. Do we sell it? No, this is too strong. If anything, the odds are we're going to pull back, and we're at the targets. Measure move. This measure move target 80.75. This measure move target 81. So we went one tick above the measured move from the open of this bar, close of this bar. I think we probably will pull back, but as far as selling, it's really difficult to do that. A good rule of thumb is, the reality is I think if a bear does sell, they'll make money here, but just out of principle, it's usually best when the channel is tight, just don't sell. The few times it's profitable will not outweigh the other times where it's not profitable. It's really easy to misread it. You end up selling here, get trapped here, not scaling in. So again, I think it's better just wait for a pullback. Now for the bulls, what do you do if 62 is a bear bar? I'd get out. The reality is the bears selling above yesterday's high are probably going to make money. Similar to down here. Bulls buying below yesterday's low, the blue line scaling in, they made money. So that makes me think that traders are going to make money down here as well. So a little bit climactic, probably going to pull back for a couple of legs. For me to buy, I'd like to see a couple of legs sideways to down and price get closer to the moving average. I wouldn't buy 62, but probably more sellers above 62 than buyers. Outside down bar, but probably buyers below and more sideways. You know, we have one bear bar out of this rally ever since down here. And while there will be disappointed bulls, maybe looking to exit around the high close, I think the best case for the bears is we go sideways. So I think the odds are against a strong reversal down. High one buy, sellers above, pull back. But it's pretty common when you get a high one to have sellers. So before the high ones initially fail, pull back and then get retested. Which is, in other words, we're probably going to be sideways here. I am still flat and waiting to see what happens. I'd rather look to buy a pullback somewhere in this area. We still may try and get up to the 82 area, 53.82, and make this a more, it's pretty close to symmetrical. We went this many points below the yesterday's low. We'll try and do the same probably for yesterday's high. Bulls ultimately want today to close on its high, but they have a lot of work to do if they're going to make that happen. They've got to keep the market up here for another basically 20 bars, 18 bars really. And I don't know if they have the energy for that. But so far, the bears have not done enough. You can call it a high too, but there might be more sellers above and we get a deeper pullback, especially with the tail above 62. As far as selling it, really not that easy. Most traders probably better off being flat. You'll have some bulls disappointed up here, scaling in lower, selling out of longs. I think we're going to go sideways. I think the odds slightly favor a deeper pullback here. What about selling below 64 or 65 since it closed on its low? I think the sell was above 64. Selling below 65, you're really selling at the bottom of a tight trading range. It closed on its low, but it's really not ideal. Signal bars that have a lot of overlap are not great reversals. And because of that, if you take the sell below 65, which I don't think is that great, you probably get out if 66 is a bull bar. Which I don't think is that great. You probably get out if 66 is a bull bar. Bears, for me to sell, it certainly on sell closes or below bars, I'd like to see more. This is what I was talking about. If you sell below 65, you probably get out if 66 is a bull bar. Swing buy for the bulls. Second entry. Bull bar closing on its high. I would certainly get out of shorts above the bar. For the bulls, you probably take the buy, taking a chance we go at least a little bit higher. But middle of a tight trading range lowers the probability. At the moment, I'm still flat. I don't want to buy this high up, and I'd rather buy closer to the moving average. What about buying the close of 67 if it's a bull bar closing on its high? You will have some traders buying, but it is a trading range, and that increases the risk that there actually might be more traders selling up here than buying. Bad looking high one, so we may end up going more sideways here. bar is getting bigger, good for the bulls. Increase the probability that we're going to go at least a little bit higher. But there will be profit taking, most likely at a new high. So a little bit tricky to be buying up here. Good bull bar, but I'm not buying up here. Again, I think we're going to go sideways. And if I was long, this would be a profit taking area, not an area to establish longs for me. So therefore, I'm trapped out. Plus, we're so close to that 82 area, which is basically the same distance from here. It's easier if I just show it. This is the distance we went below yesterday's low. Here's the yesterday's low. Here's the low of 5. If I take that same distance above yesterday's high, it takes you right to 82.25. And we're basically 3 points away from that price level. And I think we may get there, and that would make the day, that would be the same distance below and above. Let me turn the screen off. I'll show it. I'll show an example in the on the encyclopedia. Let me just load Al's. I don't have any of my own charts with this, but this is just something that Al would always talk about pretty regularly whenever we got outside days. The market likes to have symmetry, and that's part of the logic behind it. So I'm going to let that load for a minute. Looks like more traders selling and taking profits than buying the close 67. No surprise. The odds are we're in a trading range, and we're probably going to begin to go sideways here. I thought about selling. I did sell above 64 because of the tail. Whenever I take those kind of trades, my default management, if I'm selling above 64, I'm basically betting there's more sellers than buyers above the bar. So one of the ways I'll manage it is this. I'll sell the 64 high and put a stop, basically the bar range above. And then I'll set a target in the bottom third of the bar, maybe at the low of the bar. And then sell it. If it immediately goes against me, I might scale in, get out break even, depending on the context. But I'm not going to sell it and put a wide stop, somewhere way up here. If had I sold the close of 67, I would have done the same thing with that logic. Probably buyers below 68, but if I'm a bull, had I bought above 66, I would get out of shorts below 68. We're right at yesterday's high, and you can argue it's a second failed breakout of yesterday's high. Therefore, we might have to pull back even further and get closer to the moving average. The bears have a bull flag. They see a bull flag, and they want a bear breakout below it. You can also call it a double top, this high. They want to break below the neckline, 66, and then measure move down to here. Looks like some traders giving up, but let's see what the breakout looks like. As far as selling, I'm not willing to sell here. So what am I doing here? I'm flat. I want to sell, but I want to see more selling pressure. I'm not willing to sell the close of 69 because it's at the bottom of a trading range. Plus, it's at the moving average. Good bar. But as far as buying it, I think they need one more bar. By one more bar, I'd like another strong bear bar. Otherwise, there's probably buyers below 69 and the moving average. Okay, someone asked a question, any advice for tomorrow's FOMC day? They said it's probably me, but I find it difficult to trade even hours before the news. My biggest advice is with FOMC is to just not trade it. I mean, if you really think about FOMC, Ali, if you listen to Ali, he's a big proponent of that. The problem with FOMC, and I'm not saying everybody not trade it. What I'm saying is, especially when you're starting out, when you trade the FOMC, the bars are big. You get these sudden, really big bars, and it's really just not. It's probably not worth it for most people. I would just treat FOMC, treat it as a half day, and just let it be. If you make significantly more money trading FOMC than any other day, it means that your risk is probably too big. The reality is, there's going to be trades where you're going to make more. You're buying closes as the market's going up, selling closes as the market's going down. You stand to make more in those situations. But with that said, most traders you'd be better off just not trading it. Probabilities are always uncertain. Trading the FOMC is kind of like trading the open, where probabilities are uncertain. Now, I haven't actually looked at the Globex in a minute. I want to see something. Al says that 50% of the time. Let me just show the example. One of the things I pay attention to pretty regularly is whenever you get a big gap, what is the Globex market doing? Here's an example. We gapped up and we formed 3 consecutive bull bars and we immediately reversed down. And Al often says 50% of the time, whenever you get the initial move on the open, 50% of the time it reverses and goes the opposite way. That's true, and it's a generality statement though. If you look at the Globex as the move's happening, you can actually assess the probability a lot better. But here was the first 15 minutes, which is this rally right here. And you can see what happened. It's a buy climax late in the channel. Odds were it was going to fail. You see this rally here, big sell-off. Well, let's look at the 15-minute chart. Do you see this big sell-off? This is the open. What do you notice about this? 2 legs down, second leg trap, failed breakout of the lows down here. This is really not that great of an area to be selling in the first place. Triangle. So a possible final flag. This breakout, actually, there were reasons for this breakout to fail. And that would be easy to see on the Globex markets. That's one thing I do pretty regularly. I want to sell, but I need a stronger breakout. And I'd really like to see just a big bear bar with follow through and a sell backing test of the open. But we're probably not going to get that. I think the odds are against it. More likely, we're just going to go sideways. Plus, it's getting late in the day. Bar 72 is kind of, sometimes I say it's a cutoff point. Most traders should stop trading by bar 72. And after, this is kind of the area where I start to get very cautious. And I start to assume that we're going to have a lot of sideways trading. Inside bar, probably buyers below 69 and 70. This is not what you want to see if you are looking to sell. I ended up buying as the market tested the moving average for a scalp. It's kind of one of those funny instances where I bought a couple, I don't remember exactly, it went down and I said buy the market. And as it started to turn up, I accidentally have my matrix over here, and I accidentally hit, there's a yellow button, basically cancel orders. I always have an order sends order in the market. And when I pressed the cancel button, I meant to left click on place OCO since my orders got removed. And I accidentally right clicked, then left clicked. And I just learned that that actually closes the trade at the market. So the trade closed up here and I just bought. Whenever that happens, I'll often just buy immediately if the trade closed and I accidentally closed the trade but I didn't mean to. I'll often just immediately just buy the trade back at the market and just pay the extra commission. Bears trying to get a downside breakout, but decent bull bar 71, probably going to be sideways here. We had basically a low one, bear breakout 69, pullback, low 170. we triggered the sell on 71, reversed up. And you have some traders who sold below 70 or near it. They're deciding what to do here. Low one, it's common for low ones to trigger, pull back, and then try and get trend resumption. So some traders sell it, scale in, trying to get out, break even. Bears trying to get the downside breakout, but they need to break clearly below the moving average. Otherwise, we'll probably just go sideways here. Bears tried to break below the moving average, and looks like they're failing. Some bulls, although they wouldn't gotten filled, they bought at 71, rallied, bought more below 71, and they're deciding what to do here. Bears still trying for the bear breakout below moving average. Bears trying, but so far they're not doing enough. I think we're probably going to stay sideways in this overall range. But really, it's tricky. Traders are buying below things as the market's turning up. They're not buying above bars. And it really makes it difficult to trade with stop entries here. And because of that, most traders should be flat. Really not what you want to see if you're a bear hoping for a breakout below the moving average. Bears, I'd get out above 73. Too much risk we rally. And for the bulls, as far as buying here, if you're buying, you're betting on a trading range. And we could still go sideways and even go a little bit lower. So as far as buying, it's really not all that easy. Most traders are better off being flat and waiting. Again, bar 72, it's usually a good cutoff for most people. Just stop trading and wait for tomorrow. When you trade after bar 72, you can have things can be more sudden. Volume can increase. You have institutions deciding on what kind of day we're going to get, how the day is going to close, where the open is, where the high is. There's all sorts of things that can happen. And because of that, there's greater risk of a lower probability event. And because of that, you have to be much faster to make decisions. And that typically requires trading with limit orders, buying, but then quickly scalping out or changing the way you're managing it. And most traders cannot react fast enough to make that profitable, worthwhile. It's another reason why I like things like TradeZilla. And again, there's dozens of things you can use with those. Just use an Excel spreadsheet, but record where's your average trades? If you broke the day into 3 or 4, let's just say 4 different time slots, or 3, middle, beginning, middle, and end, over the course of 60 or 90 days, where are your greatest losers? Are you winning mostly in the beginning of the day and then getting it back in the middle or last couple hours of the day? If you are, then you want to think through, how do you adjust that? Another common issue, traders will take bad trades on the open, lower probability trades, selling the close of 5, and they'll take a big loss, 6, 7, 8, 9, and they'll spend the rest of the day making it back up, where you might find that on the open, if you wouldn't trade the first 6 or 12 bars and you waited and then traded the middle or earlier in the beginning of the session, in other words, wait till bar 12 or 24 to start trading, you might actually take less bad trades and have a better winning percentage. So the point with that is you have to examine the data behind your trades. So this is what I was talking about, getting the reversal up. But by the time it's clearly reversed, it's really tough to buy it. Do you really want to buy above 74? No. I'm one of the bulls who have been long, taking a chance we'd bounce. And we're in the zone where I want to take profits. And very often when I take those trades, I'll trade a smaller time frame and basically put stops below. So if I'm trading, let's say I'm trading a 2-minute chart, which I'll often look at a 100-second chart. If I'm doing something like that, I'll watch these bars and I'm going to be really quick to tighten stops. And if there's any reason, if something happens suddenly, I normally just exit the trade. I just went flat, and that's probably the last trade I'm going to take today. So why, on days like today, just to get perspective, just because I'm trading a smaller time frame at times, days like today, I think, I'm just trying to remember the sells that I've taken. I think I sold once in here and once here. So I think I only took 2 sells today. I'd have to double check, but I'm pretty sure that's right. And the reason I'm bringing that up is I'm always paying attention to day structure. And the reason I'm paying attention to day structure is I want to focus, if there's a clear always in direction, I want to trade in that direction. So rather than buying, closes up here, I want to buy pullbacks, but I'm still more interested in buying than selling. I'm just reading some of the questions that people have submitted in the GoToWebinar platform. Someone asked a question. I'll talk more about it after the review, but they asked a question about they have a full-time construction job and they're listening to Al. They're listening to the trading room every day. And basically, they can't be in front of a computer. So when they hear a setup, they'll immediately jump on their computer. And I'll go ahead and give my 2 thoughts on that. If you can't be in front of your computer all day, or at least when you're going to trade, I would really focus on higher time frames. It's really easy to feel tempted to want to trade a 5-minute chart from your phone or be halfway distracted. But what I really would recommend, look at other time frames, other markets. It's a common misbelief that markets are different, patterns are different, therefore I can only trade the 5-minute E-mini, and that's just not true. One reason why I build all these charts. It's a reminder that markets are fractal. Patterns work the same. A lot of these are the ES, or the Globex, but there's several of them that are euro-dollar. 5-minute chart of the euro versus the dollar, big sell climax, but below the moving average. I only want to sell. So the reason I'm bringing this up is here's the euro versus the dollar, 15-minute chart. And if you look at this chart, obviously it's 4 a.m., a little bit late, but let's say it's 10 a.m. right here. Strong break above the moving average, buy the close, hold for a second leg. You have a strong sell-off below the moving average, pullback, bear bar closing on its low, 5 in the morning, sell below that bar, stop above, hold. 3 consecutive bear bars here, sell the close, stop up here. And hold for some kind of second leg. Go for 1 times your risk. Big bear bar, 15-minute chart. Just sell the market. Sell the follow-through bar. Pick something and hold it. Triangle, second leg down, look to exit. So Forex markets are a really, really good choice, especially if you can't be in front of the screen all day. You can trade a 60-minute chart. Something like this, consecutive sell climaxes, really big bull bar. You can buy it, buy the close for a small second leg. And look what happened. Even after this sideways trading, you still got a second leg up. Consecutive sell climaxes, but tight bull channel on a higher time frame. Well, really what I'm saying, bull trend on a higher time frame. So bull trend, and then trend line break. You get a reversal. You can buy there. Small second leg up, traders exit. So anyways, the point is, look at Forex markets. You can find they're really, really helpful. I used to have a hard time, someone told me that, I would say, look at Forex markets in the chat room, And I never liked that answer, trade higher time frames. I wanted to trade the 5-minute chart. But the more you look at charts and the more you just start to understand the logic, the big bear bars, they reverse, big bear bar here, reverses, big bear bar here, reverses. All of these are trading range bars. Even this, as strong as this is, guess what? It's a trading range. And there's probably buyers below, but it could be an expanding triangle. So the bears, it's possible the bulls get trapped here. I know it's not the answer you wanted, but that is one thing that I would highly consider. We had a small second leg. We're getting a small second leg up, but we're past my cutoff, and therefore I'm trapped out for the rest of the day. I'll start the review here in about 14 minutes. It's easy to look at a bar like 74 and just immediately hit sell the market, and you can get a fairly deep pullback. I still think we'll get a second leg down, but do you see the issue? Does anyone see the issue with 74? Excuse me, 76. This bar, the issue is possibly 3 legs down. And right now, looks like more traders are buying it than selling it. So not really all that ideal. Obviously a mistake if a trader sold the close of 76. But late in the day. So it's fun to watch all this, and that's exactly what the majority of traders should do. Watch and enjoy the battle of what's going on here. We're right around yesterday's high, and the market's deciding we're going to close above it or we're going to close below it. Big bull bar, 47. But what do you think the issue is with 47? It's a big bar with big risk. So if traders are buying a bar like 47, they want the market to go up there quickly. Otherwise, they'll exit the trade. If you look at a 1-minute chart of this, you can see we had a sell-off. This is what I look for all the time. We had a strong bear breakout, but bear breakout below a bear channel. Channel failed. And sell vacuum, we got an endless pullback. I have a lot of those today. Big sell-off, sell vacuum, endless pullback, big sell-off, endless pullback. Very climactic sell-off, double bottom, endless pullback. This is why I say it's important to understand that markets are fractal. You have a rally, strong buy climax, traders are going to take profits. The more time you spend looking at charts and just the more experience you have, you start to be able to apply it on smaller time frames. But anyone that tells you that you can't trade a 5-minute chart, can't trade a 1-minute chart, can't trade a 10-minute chart, it's totally a lie. You can trade a 15-second chart. The real factor is speed. Obviously, there's a time frame that's too fast. But any time frame is tradable. You just have to think through the variables. The speed, commission, slippage, all those pieces are variables. This is what I was talking about, though. Buy climax, high in the range, increased risk that there's more sellers up here. And you can see, traders rallied, we went to a new high, we immediately pulled back. If I was long, I'd get out here. This is just, we made a new high, and the risk reward is getting bad for the bulls. And I don't think we're going to close the day on a high. We might, but I suspect it's going to have at least a small tail. In other words, I think we're going to oscillate around yesterday's high. That's where I'm getting at. Strong breakout bar. So good for the bulls, but too late to be doing anything. Thanks for being patient, everybody. So interesting day. Daily chart, tight trading range, a little bit of an expanding triangle. And the bulls, we sold off on the open, and we ended up rallying, closing above the day. So that's good for the bulls. But what do you notice? What do you think the issue is with today's bar? It's an outside bar in the middle. It's an outside bar in a 4-bar tight trading range, and that lowers the probability for the bulls. The odds are we're going to get a small second leg from the rally over here, June 5th. We'll probably get at least a small second leg up. But expanding triangle here, this is a trading range. So while the bulls are doing a good job, my one thought is trading range market, I expect the bulls to be disappointed fairly soon. Just out of curiosity, let's look at the weekly chart. Weekly chart, we tested back to the high of this big bear bar, sellers above, and we tested it 3 weeks ago. And we're forming a bull bar, but overlapping a lot of the prior bar and a pretty big tail on the last week. So I think we're probably going to go mostly sideways here. We'll probably pull back fairly soon. Maybe we're 15 points away from 4,500, so we'll probably have to get there before we pull back. But I think we're going to start to pull back fairly soon on the weekly chart, at least for a couple of weeks, and test near the moving average. 5-minute chart, we had a bear bar closing on its low. And it's a good bar for the bears. Follow through after the gap down increases the probability that we're going to go at least a little bit lower. But tail below 1 and relatively big bar at the bottom of near yesterday's low. So a trading range, probably buyers somewhere below. But the buyers may not come in until yesterday's low, the blue line. Whenever I have a chart up and I'm trading, I always adjust the axis. I want to always leave room to the bottom and the top. That way, if I have the market right here, I'm thinking to myself, it's easy and from a psychology standpoint to think you're at the low when you're really not. The low could be, obviously way, way down. So I always like to adjust the bars. Bar 1, bear bar. Bar 2, follow through. Consecutive bear bars, good for the bulls. Good for the bears, probably going at least a little bit lower. However, the issue I have with the follow through here is bar 2, the most of bar 2 overlaps 1. There's a small part of 2 that doesn't, and just look at the bar. The bears failed to close far below 1. That increases the risk that this is going to be a sell-off and a leg in a trading range. Bar 3, 3 consecutive bear bars, but tails, lots of overlap. 3 is breaking out below 1 and 2. That's good for the bears. Probably always in short sell to close at a minimum. I think we'll probably test the low of yesterday. And we did on 4. 4, strong bar, surprise, good for the bears, probably going at least a little bit lower. However, what do you notice about the bar? It's a sell climax. And sell climaxes at obvious support, like the low of yesterday, you can often get a reversal. Whenever you get a big climactic bar, really big bars are not great bars to trade. Very big bar, 50 to 52, deep pullback before you got the second leg. That's pretty common. I mentioned that over here, buy climax bar. Not over here. I was talking. So where was it? I think it was here. Buy climax, pulled back all the way to the bottom of the bar, and then went higher. So anyways, whenever I see something like this, I always pay attention to the Globex market, because very often the market often reverses. Whenever you see these big bars that reverse, they're variations of parabolic moves on smaller time frames. So here, big bear bar 4, but if you go to the 15-minute chart, let's do a 30-minute chart so it's easier to see. Here, this is a bear bar late in the sell-off, and you can see failed breakout below the lows down here. So there's a lot of support It's really yesterday's low here. So a lot of support and a lot of reasons for the market to reverse. Then you see what happened on bar 5. The market rallied on 5, pulled back on 5. So the bears who sold the close of 4 and scaled in higher were able to exit back at the close of bar 4. 5, 6, 6 bull bar closing on its high. I think they're always in bears. It's reasonable to get out. 6 is enough of a surprise. We'll probably get a second leg up. Therefore, the first reversal down is probably going to be minor. 2 seconds. And then 7, bull bar, but a bad low 1, probably buyers below 7, and at least a second leg up. Tested before high. 8, now we have 3 consecutive bull bars. Good for the bulls, but a tail above 7, tail above 8. I still think we're probably going to pull back here. And then 9, now we have 4 consecutive bear bars. This is a problem for the bears. This could just be the sell-off to 4, could just be a sell climax that leads to a reversal. And if you're a bear and you sold the close of 4 and you scaled in higher, you're in a lot of trouble right now. And because of that, you'll have traders beginning to buy back shorts, buy to go long, and add as the market goes their way. Now I want to say something before I forget in regards to that. This is a great example of why traders add to their position. They buy on the way up, it gets too climactic, they start reducing their position. So they're buying all the way up, climactic bars, they start taking profits. They see this, they scale in, they get out on a retest of the highs. The market's in a trading range, strong here. Sell-offs, they wait for 2 or 3 legs down to start building up a position. Some traders call it accumulating or accumulation. They build their position, market starts to test up again, and what do? A lot of those traders reduce their position. And then they start building up their position again, and they reduce it. So good for the bulls. Doji 10, probably buyers below. It's possible we have to test all the way down to the 4 close or the 5 high, or a 50% pullback from the low of 5 to the high of 10. That's a possibility. But at the moment, buyers below 10, second leg up likely. 11, bull bar closing on its high. This is a problem for the bears. You can argue parabolic wedge, 7, 9, and 11, but parabolic wedges are minor reversals, which means the best the bears could probably expect is a couple of legs sideways to down. So a lot of traders are not going to be all that thrilled about taking these trades. 12, bull bar closing on its high. Micro channel since 6, probably buyers below, second leg up. 13, inside bar, but again, buyers below. Even if we have a deep pullback, 50%, testing somewhere around here, 53.44, the odds are we're going to get a second leg. 14, bull bar closing on its high, good for the bulls. And again, strong enough rally, we've probably seen the low of the day. So bulls are buying and they'll look to scale in lower. 15, climactic bar. Therefore, we may have to pull back for a couple of legs. But even if we do, there's probably buyers below. If you're a bull and you're buying the 15 close, you're not getting out of the 15 low. You're getting out when there's this clear, strong breakout with follow through. 16, bear bar, pull back from the climactic bar on 15. Also, part of the reason 15 broke out is it broke above the 1 high. In theory, where the bears would put their stops. You had some bears selling above 1 during 15, scaling in higher, getting out on a retest. 16, high 1 buy, breakout, pullback buy, probably sellers above. But when you get a buy climax like 15, climactic bar, 60% of the time, usually you get a small second leg. And that's what 17 is. Another bull bar closing on its high. Another buy climax increases the probability we're going to pull back fairly soon. But buying up here is really problematic. Let me back up. Selling up here is problematic. Why? Because the reality is anyone who buys the high close or the high tick of this move and uses a wide stop somewhere down here and scales in lower, the odds are they're going to make money. 18, another bull bar, but smaller body, probably going to pull back soon. 19, outside down, testing the high 1. 16, it was a bad buy, and the bulls that bought above it at their entry is 58 even, and you can see the high of this bar, 62. So the market went exactly 16 ticks above, it actually went 17 ticks above the high of 16. In other words, price, if you bought above this bar, your entry price is 58 even. The market went exactly 4 points, 62 even. If you had a target at 4 points, it would have touched your target, but you needed it to go to 62 and a quarter in order to get filled. Very common. You have other bears, they don't sell the high of 16, they sell 3 or 4 points above it. They didn't get filled if they sold 4 points. 19, outside down, probably buyers below. 20, same thing, buyers below. 19 and 20 strong enough that will probably get its own second leg. Therefore, probably sellers. The bulls who bought the close of 19, disappointed with 20, probably sellers back to the close of 19 for a second leg down. That's what happened with 21. But selling the close of 21 is really dangerous. You're selling at the moving average in what's likely to be the bottom of a trading range. And that's why 22 looks the way it did. 22 broke below 16. We had a spike 15, pulled back 16, start of a channel, channeled up to the 19 high, and we're pulling back to the 16 low. 22, almost outside up. Good bar for the bulls, but big bull bar forcing you to buy relatively high. And that's why 23 is a relatively weak entry bar. You had some bulls who bought the low of 18, and they're disappointed 19, 20, and 21. What do you think they're going to do on the rally 22 and 23? They're going to exit their longs. Had I bought the 18 low, what would I do? If I bought the 18 low at 59 and a quarter, the high of this bar, 59 and a quarter. And then price went above it. I won 22, probably sellers above, but the first reversal down is likely to be minor. And because of that, the bears who are selling above 22, which is a really dangerous trade in this situation for many reasons, the bears who sold above 22, when they see 23 and 24 follow through buying after the high one, 22, a lot of those bears are going to buy back their shorts. One of the reasons why it's really dangerous to sell 22 is 22 is actually it's not really a high one. It is when you look at this chart at face value. But if you really think about, if you really dissect the chart and pull up a 1 minute chart of this sell-off, the market sold off with 19 and 20, pulled back on 20 here, or 21, it went up and then it went back down. So the bears, in theory, who sold the close of 20, the second bear bar, they're disappointed by the pullback during 21, and we got a second leg down with 22. So technically, selling above 22 is selling high too. That, for some people, that's probably easy to understand, and you already knew that. For others, that may sound complicated. If it's complicated, go back on the recording and think about what I just said and how markets are fractal. I want to say another thing really quick as far as Discord and all these things. There's a lot of chatter back and forth in the trading room chat, and that's fine. It doesn't really bother me. The only thing I would say though is, trading can be kind of lonely, and it's very natural for people to want to, make friends, chat back and forth. And the reality is, even if you have a lot of friends, if you talk to them about price action, they're going to get bored and look at you with the question mark on the face. I have zero friends other than people outside of Al Brooks, let's say, that I talk about in regards to price action. So I get the feeling, I say that. What I mean by that is I'm not going to go. I have people that I talk to that have studied Al and they understand Al, and I talk about price action with them all the time, but they understand price action. I'm not going to talk to my friends who have never studied trading about price action. The point I'm trying to make, though, is this. Make sure while you're chatting on Discord and you're commenting back and forth, make sure it's productive. It's really easy. It's really easy to have conversations with people and it not be that productive. The best thing you can do in learning how to trade, someone made a comment that they're amazed that a lot of people understand trading really well. And the reason they understand it is just because they've thought about it long enough. And that's one of the reasons why I'm confident in my understanding of price action. I just thought about it for a long time. There's still tons of mistakes that I make. And the way I fix those mistakes is the exact same way I learned how to understand. It's the exact same thing I did on video 1 or chapter 1 of Al's books. I read the concept and thought about it. And the more I thought about it, the more I learned. The more amount of times I've sold here and just scaled in all the way up, guess what? I've done that enough times. I know the outcome of doing that. And so therefore, now if I'm ever short and I start to see this 3 or 4 bars up, I have that just alarm bell in my brain saying, exit the trade. It's already gone too far. You got to get out. It's kind of like you have no choice but to exit. So the point is, make sure you're studying. Make sure you're thinking about charts. Make sure you're marking up charts. The biggest characteristic I saw in Orlando. Let me back up. I think the biggest characteristic with people in trading, the ones that'll figure it out, the ones that won't, it's their willingness to think about a chart. Some people, they just want the answer. Tell me what to do. How do I trade this? What do I do? What do I need to do? That's the wrong answer. The real thing you should do, take what Al says in the videos, take what Al or whoever talks about in the trading room, pull up the chart and really think about what they're saying. Does it make sense? Can you understand it? Mark up charts. So anyways, back to our high 1, that's really a high 2 on bar 22. If you're selling here, bears are getting out, and that's why bulls are buying. And that's what led to 25 here, going up a little bit. We went above the 18 high. Bulls bought the close, scaled in, getting out break even. 25, double top, above 18. Minor reversal. So traders, if they're selling here, more likely it's going to be minor. What about buying below the 25 low? Some traders will, but climactic rally from the 22 close. You think about it as a parabolic wedge, up, down, and up, and then down. So instead of buying here, you have other traders more interested in buying below 22. But the reality is, I think buyers below scaling in. Surprise 27, but buyers below the 22 low, scaling in lower. Inside bar 28, probably buyers below. Strong enough sell-off on 27, I think we'll probably test down to the close of I think we'll test down to the 27 low over the next couple of bars. Low 1 short with 28, probably buyers below. And then we reversed up with the low 1. Low 1s often pull back and get trend resumption, so buyers below 28. But there's also probably sellers above 28. 29, probably buyers below. And then we broke below 29, reversed up on 30, or say 29. 30 is the bear bar, buyers below 31, bull bar. Now we have a parabolic wedge. I think it's reasonable, 31, always in bears, probably get out, and aggressive bulls can buy. But a lot of those bulls buying, I think they're probably going to use a wide stop. Some will buy, put a stop below 31. And I think the ones that do, they're aggressive bulls. And a lot of those bulls that are buying here, this is just my premise. If I bought here and I put a stop 1 tick below, I'm going to be pretty quick to exit the trade. Otherwise, with this context, I might buy a small position, wide stop, and build as the market goes up. 33, bull bar, but a small second leg after 31. So aimed at the moving average. There might be more sellers above. 32, reversal back down. Tight trading range, you call it breakout mode, holding below the moving average. We broke below the moving average 27. We went sideways here. We'll probably get another leg down. And that's why 35 went down and then 36 reversed back up. Final flag. You can call it a failed breakout below this wedge here. Always in traders. I think they're long. I think the bears are out. And bulls, they can buy above 31, use a wide stop. Maybe buy, put a stop and measure move down. They can buy, get stopped out, and then double their position above 36. But you got to be really careful with that. And then 37, 38, a doji, 3 consecutive bull bars, buyers below, second leg up. 39, bull breakout. closing on its high, testing the high of 28, so the top of the channel. We had a spike 27, pullback 28. We channeled down for several bars, and then we rallied, testing the top of the trading range. For the bulls, 39, a little bit climactic, so we may pull back here, and that's what we did on 40. 40 tested the bottom of the buy climax 39, and by the way, these bull bars here, it's a wedge. That's why it pulls back so common. We rallied 36, pulled back 37, rallied 38, pulled back, rallied again 39, pulled back. It's basically the same exact logic as when the market breaks out above a channel, it typically reverses and tests the bottom of the channel. You would see that if we looked at like a 1-minute chart. Bears, they failed to get follow through buying, and instead the market reversed up, and then 42 bull bar, and then we finally we formed that big outside up bar. Bears got a second leg down after 40, but once it tested the low close, you can see the low close here, 51.25. Look below this bar, 51.5. The market came within the one tick of the low close and shot up really quick. And that was a strong enough surprise that the odds were we were going to get a second leg. But then, 43, we got a doji, disappointment bar. A lot of bulls who were long, who bought the close of 43, disappointed 44. What are they going to do? I said 43 disappointment bar, I meant 44 disappointment bar. A lot of those bulls who bought the 44 close will look to exit back at the 43 close. And then you can see 45 tested above the 43 close. 46, bear bar, second entry sell. Always in traders, I'd get out below. Too much risk, we sell off and test the low of 43 and possibly the low of 36. For the bears, they can take the sell for a swing below 46, but they need a pretty strong entry bar. Otherwise, probably buyers somewhere below. And then bear bar, 47, they need a strong entry bar after the 46 second entry. 47, great entry bar, but bad context. I think the bears need at least, if the bears get a second big bear bar closing on its low down here, then we're probably going to the high of 5 and the low close of bar 4. But without it, chances are sellers above and more sideways. Let me back up. Without it, probably sideways. I think we'll get a second leg down. I do think that's going to happen. And then 48, what happened? As soon as 47 closed, bulls immediately bought 48. And it was a strong reversal. If you look at a 1-minute chart, you'll see the reversal is pretty strong. And it trapped bulls. It trapped bears into a bad trade. Doji, 49, probably buyers below. And then a give up bar, 50. Strong enough reversal of 46, 47. Plus, context makes sense for the bulls. We had a rally. Complex pullback, test of the highs. And this might just be a deep pullback of the 1215 bar right here. So this pullback here could easily test back to the high close. And, I was saying for quite a bit today that I thought the odds were we would get a second leg from this initial rally right here. Then we went sideways for several bars. Bull breakout 53, possible parabolic wedge, 49, 50, and then 53. But it's a parabolic wedge breaking out of a trading range from bar 18 all the way to 51, and that's a really dangerous area to be buying, to be selling. 54 follow through, probably going to go at least a little bit higher. 55 more follow through. Now we have a more obvious parabolic wedge, 1, 2, 3. So we're probably going to pull back for a bar or two. Surprise bear bar, 56, closing on its low, but a possible sell vacuum tested this breakout point here. Breakout point, high of 46, 45 here. It's also possibly just a breakout test of the 24 high. Point is, we have a sell-off testing the top of the trading range, and traders immediately bought the close. I want to say one thing about that. We didn't immediately reverse up on the open of 57. We stalled and then slowly started to reverse up. And when we reversed up without pulling back any and we continued to go up, you had more and more traders. You had more and more bears panicking out of shorts and buying back shorts, and more bulls buying to go long. Follow through 58, I mentioned over here, I thought we were going to test yesterday's high and probably go the same distance above yesterday's high as we did below it. And then we have 58, 59, 3 consecutive bull bars, still by the close and buyers below, but you're right at the target of yesterday's high, so not ideal. 60, bull bar, closing on its high, still by the close going higher, and then obviously we formed this doji we formed a bar with a big tail, 61, and I thought at that point we were going to go sideways down. High one buy 62, sellers above, bad stop entry, but the reality is if you buy above 62, use a wide stop scale in, you're probably going to make money, although not ideal. 64, bull bar, you can call it a second entry, but a big tail above the bar. Bad stop entry buy, forcing you to buy high in a trading range, probably more sellers above. 65, bear bar closing on its low. For the bears, would I sell it? I would not. I think there's probably buyers below. And you can see that's what happened with the next bar, 66. 66, bull bar closing on its high. Good for the bulls. Probably going a little bit higher, but middle of a trading range. Probably sellers somewhere in the upper portion of this range. 67, good bar for the bulls, but probably more sellers than buyers. 68, bear bar, probably buyers below, but the buyers may not come in until the 66 low or the moving average. And then 69, good bear bar, but similar situation to the 67 close. Bear bar 69 at the moving average and at the 66 low. Traders selling it run the risk of getting a reversal, which is more likely. And then we didn't even trigger the sell below 69. Instead, the market went up. 670 tested the low of 68, where some bulls got trapped, and the high of 66, where other bulls got trapped. Some bulls bought above 66, scaling in lower during 69. Disappointed, getting out break even, 66 high. High of this bar is 76.25. High of this bar is 76.75, which means your entry, if you bought above 66, is 67 even. And then look at the high of this bar, 67 even. So it touched the bull's entry price above 66 on 70 and then went back down. Probably buyers at the moving average below 69 in this area. And that's what happened with 71. 71, good bar for the bulls, but forcing you again to buy in the middle of the trading range, not ideal. 72, a bear bar, probably buyers below 72 and at least a small second leg up. Bears, they really need to break far below the moving. They need to get a clear breakout below the moving average. Otherwise, chances are we're going to go sideways to up. And then we formed a bull bar 73. I thought that was good for the bulls. You can take the buy for a swing, but really, not great. And then when you got this, a lot of bulls that bought, they'd scalp out somewhere in here. Surprise bar 76. You can take the sell, but remember what I said? When you take these kind of sells and several legs down, what do you think the risk is? That right there. So for a lot of traders, they don't do this. One big bar, they need to see another strong bear bar. Otherwise, we may just reverse. And then we rallied, closing the day above yesterday's high and, obviously on its high. Really good day for the bulls, but context on the daily chart is not that ideal for the bulls. I think we'll probably go higher, but, if I was trading a daily chart, just look at this chart. Pretend it's a 5-minute chart. Just forget what the price axis and time axis is. You're looking at this right here. Change it to an ES chart so you can't see the gaps. Do you want to buy this? You might, but lots of trading range price action, big sell-off, overlapping bars. We could easily trigger the buy here and sell off. So really not ideal. Stop entries. Let me talk about always in. Always in. Bears, they can sell for the bears, they can sell the close at 2, sell the close at 3 or below, and then they get out above bar 6, this bull bar, bulls, they can buy 6 or they can wait and buy 8, 9, 10, 11, any of those bars. Some bulls get out below 19 but minor reversal. Other bulls, they get out below 26 or a couple points below 26 And then the bears, if they're short, I'd get out of shorts above 31, and I would not sell again below 34, probably buyers below. And then bulls, if they're long, they're either long from 31 or long above 36. Bulls get out below 46. Bears, they can sell below 46, but if they do, they probably get out below 40. They probably get out above 48, or certainly as 49 closes, 49 is a bad low one. Or they can exit as 50 reverses up, and it's always in long. I think you get out anywhere, get out below 65, get out below 68, anywhere in this general area, get out above a bull bar, a retest, get out above a bear bar. Any choice is fine. And then really not ideal always in. This is all minor reversals, and it's basically a limit order market. Lots of traders, when they see this kind of day, rally, tight trading range, they just start buying below things, betting that the market's going to reverse. That's generally my preference. Well, I want to find a dominant feature and then trade in that direction. So whenever you have a strong rally, and the odds are you're going to have a trading range and probably a second leg, I start looking to buy 2- and 3-legged sell-offs, betting that we're either going to test the high of the range or in the upper third, or we'll break out to the upside. But I'm more resistant to selling. Limit orders, I thought buyers below, but we didn't get a limit order buy until the 18 low, and that is a 12-bar bull micro channel, so really not ideal. Probably buyers closer to the moving average or the low of 16. I thought sellers above, but the sellers may not come in until near the 18 high, and I'm really not a big fan of selling that when you get this strong of a rally. I thought buyers below 28, buyers below 30, buyers below 33, buyers on below 54, 55. I thought sellers above the high 1. I thought sellers above 64, buyers below 70, and that's probably it for limit orders. There's obviously a lot of other limit order trades, but those are, I think, reasonable ones. Buy the close, sell the close, probably sell the close at 3. Selling the close at 4 is dangerous, and if you understand it, you probably get out on the close of 5, which is why 6 did what it did. 6, buy the close. 6 is not buy the close, but buy the close probably 9, 10, 11, any of those bars. And I thought 21 is more of a buy the close bar than a sell the close bar. Probably same thing with 35, probably more buy the close than sell the close. 43, I would not buy it. I think it's a pretty dangerous bar. And I mentioned I was long. I was already long from over here, but when the market went up and then it pulled back 44, I immediately moved my target to the close of 43 and exited on the close of the bar. Based on the premise was bulls who bought the close of 43 would be disappointed at 44 and then get out on the bounce. I thought buy the close 50, 51, 52, any of these bars, buy the close 56, buy the close anywhere up on the way up. And then here, after 2 or 3 legs down, I thought buy the close. And that's probably it for buy the close, sell the close. Let me take a look at questions. Can you please explain why? There's a question. Can you please explain? I got to move the question box out of the way. Let me just make it smaller. Here we go. Can you please explain again why the sell on 46 or 47 here, so 46 or 47, should not get a second leg or go a little bit lower? Well, I thought, that's not exactly what I said. I thought 46 and 47 was strong enough for a second leg down. In other words, I thought 47 was a surprise. Therefore, the bears who sold 47, if they sell more higher, they should at least be able to get out break even on the trade. And if you look at a 1-minute chart, that never happened. This bar actually went straight up. It never allowed the sell to close bears on 47 to avoid a loss. And if they scaled in higher, they got trapped into a larger losing position. And that's what helped fuel the breakout. Great question. I have trouble with re-entering the market after quickly taking profits. Sometimes I just watch the market go and go and go Any advice? Yeah. One is think about what the market is doing. It's easy to look at this and, just be paralyzed thinking, oh my gosh, if I buy here, what if the market reverses? Well, what if it does? What's the chances of it? It's actually pretty low. The odds are, it's easy to think that this can do what this did. So we had a sell-off, immediate reversal, and you look at that and you think, oh my gosh, if I buy up here, what if we just crash all the way down? And the longer you trade, the more experience you have, the more you look at charts, the more you just start to understand, yeah, we're not going to sell off all the way down to the 4 low. And the odds are, and you understand what's going on. You know that bulls are buying, scaling in lower. You understand that this here looks like this right here. And that is a stronger breakout on a 45-minute chart. So look at that. Do you look concerned buying here? No, of course not. So what I would do, I think the easiest way is to trade really, really small. And what is small? Small is I don't care if I could lose 40. Small is I could put a stop all the way down here, and if the market just raced down to 53.20, I would not sweat the loss. For most people, that means they can't trade micros. That's why I'm a big fan of trading something like the SPY. What really helped me learn a lot about trading was actually trading the SPY, because you could trade, 3, 4, 5 shares, and you're risking, a few dollars, and your stop's all the way down here. And if I bought 5 shares here, what I realized is, hey, if I buy here, and I just buy another 5 shares, and I buy another 5 shares, and I buy another 5 shares lower, just layer limit orders down, what's most likely going to happen? It's probably this. Now, the more you trade, the more you start to learn that there's more efficient ways. Like, don't buy here, buy near the moving average, scalp out, or buy, scale in, scalp out. The longer you trade, the more you start to pay attention to leg counting. But the point is, the reason why you have a fear is, I'd spend more time thinking about breakouts than second legs. Most breakouts have a second leg. That's why I talked about on the 15-minute chart. If you go back on the recording, I mentioned several times that I thought we would get a larger second leg than this. And even here, one of my reasons I thought there was buyers below, I thought at a minimum we would test these highs and probably try and break above it and get some sort of leg 1, leg 2. So something like this, leg 1, pause, second leg up, which obviously we got that. But that question goes into, basically how do you learn how to swing trade? And the way you do that is you force yourself to enter. One of the best things I did was I tried to trade always in. And that was the only thing I would trade, always in, force yourself to stay in the market at all times. And it helped explain price action. It helped me better understand major and minor reversals. And there really is. There's no difference. If you sold the close of 1 and you sold the close of 5, it's no difference. Same trade. And if you find yourself, it's not open profit. It's not, if I sell the close of 1 and I exit over here, it's not break-even money. You lost everything from here to here. And if you do that enough times, you're going to have a losing strategy. So the key, trade really small and force yourself to enter. And prove to yourself that even if you buy here and you hold for several bars, odds are it's probably going to go sideways. A question, Al mentioned that 12 or 13, the 12 or 13 high is a good area for the bottom of the range to test. The 12 or 13 high is a good area for the bottom of the range to test. Other than a breakout point, is there any other significance to the 12 or 13 high? Yeah, there's a few things. One, it's a moving average. So you look at this rally, the bears are clearly in trouble, but it's not clear that they've lost. We haven't broken above the moving average yet. But then we start to get a strong breakout above the moving average, and traders begin to conclude, yeah, the markets probably came always in long somewhere in here. So what do? They look for breakout points. Ideally, where traders got trapped. Some bears, they sell the close of 4 and they sell more of the moving average, put a stop up here. But when the market breaks above the moving average like it did, all those traders are trapped on the losing side of the trade. And you see this? It went down to the red line, the moving average price, and then immediately, several times, and then reversed back above it. So where do we go tomorrow? I think I suspect tomorrow will be a disappointment day for the bulls. So if I had to guess, it's probably going to be some kind of a doji or a weak bear bar. It's possible we get a reversal bar, but I suspect it'll be disappointing. Okay, thanks everybody for listening, and I hope everyone has a great rest of their day.